Hello, everyone. Thank you and welcome. Welcome to today's annual investor conference of Tenvalue in collaboration with our association. If I may just say a few words about Hub Plus. We are a not-for-profit association based in Geneva, and the main goal of our association is to defend the interests of our members. Our members are independent financial advisors, trustees, independent wealth managers, and also private banks, and all the different independent professions in finance. We also welcome individual members who are directly or indirectly linked to finance, and we represent our members towards the regulators as well. So we are a very direct contact with specific regulators like FINMA, the Federal Finance Department, and the goal of our association is to go through all the different interests of all of our members directly, taking care of their own businesses. So we are the middle point for our members to be together and and we help them to strive and to create their own continuing businesses together. We organize very often educational conferences and trainings as well. The trainings that we organized are, for the moment, most of them have been in Geneva and in Lausanne, and now we are expanding to the Swiss-German side as well. We were founded in 1993 under the name of GSCGI, which stands for Groupement Suisse des Conseils en Gestion Indépendants. It was a long name. At that time, it was very modern to have this kind of long names. But in June this year, we changed our name, our logo, our website, and now we are Hub Plus. I have the pleasure today of welcoming all of you, and especially our member Tenvalue, and Javier Rivas, who will now, and Alexandra Petrovic, who will now speak about Tenvalue. Thank you so much.
Thank you, all of you, for joining us today. Thanks to Lilian of Hub Plus. We're also very grateful for the collaboration. And thank you to all entities featured on our platform. We will continue doing simple things repeatedly over time. We will only speak about value creators. You can see on the slides, it is not about us, it is about value creators, both listed companies and asset management companies. We like both low-cost passive funds and active funds, which have been adding value for the very long term, and we like listed companies with good business models, good management teams, and attractive prices. Over time, you see more and more and more entities joining our platform. The number of listed companies which can be seen on our platform has increased by more than 2 times since the end of last year. And the number of asset management companies has increased in line with our expectations. We think this is a win-win-win. We think this is good for investors. We think this is good for entities featured on our platform. And we think this is good for Tenvalue. Why is it good for you? Why is it good for investors to take a look at our information? It's good because there are thousands of funds in the market. There are many, many, many funds in the market, and we've researched most equity funds in the European market, and we have awarded our ratings to fund managers who have outperformed the benchmarks with a very simple criteria. So first you can see our ratings, and on our website you can filter by sustainable funds, size of funds, the area in which they invest. So it's very simple to filter funds thanks to our search engine, which will be updated at the end of this year. In a few months, you will see the updated information. And then you also see, apart from entities which have our ratings, you also see entities which we consider value creators. So we simplify information. First, we only speak about value creators, and then we simplify the information. Many times, many people can think, wow, there's so many different options, this is too complex. We aim to simplify that information because you don't need to understand hundreds and thousands of funds, you just need to understand what the best of them do, and we're aiming to show you on the platform what the best are doing. Regarding listed companies, we're also very proud and satisfied with the entities which are featured on our platform. Last year in Zurich, we spoke about Libertas 7. We were saying that the entity, the real value of the assets was 5 times more than the market cap. I think some people were thinking, well, that cannot be possible. So since then, we're also glad to say that the price increased by 3 times. We think that the value is still higher than the market cap. Today, 3 entities which we really like, we also present. Catenon, Swiss-based Implenia, and Swiss-based Aevis Victoria. We really like the 3 business cases, and both Catenon and Aevis Victoria, the market cap is around 1,000 million euros. Catenon is smaller, the same as Libertas 7, and we also think next year, in 2 years, people will be speaking about those names. In summary, we simplify and we only speak about value creators, and we hope that you always find that information useful. So it's good for investors, good for entities featured on the platform as they get more visibility, and it's good for Tenvalue. As the entity grows, we learn more. As we learn more about things that we like, fortunately, we like what we do. We think we will be here over the next decades speaking about listed companies, about asset management companies, and about the economy as a whole. We like understanding all these topics. So as we learn, we share this information with the public, and we think it's also positive for everyone. Alexandra is going to briefly explain our ratings, and then, yeah.
I'll be extremely brief because I think you just summarized everything that was important. So, our mission is actually supporting value creators with their data and knowledge, with the vision of being a useful platform for professional investors and always staying true by our values. We only want to provide information that is useful for you, that is useful for professional investors, and that adds value. So basically, one of the first tools we've put online on our website that's actually really accessible, so you can just have a look at it. We've just tried to make a rating very simple, so that the criteria, you can follow it. Taking only a look at fund managers in the European region that have had long-term performance quite outstanding. And in this case, we have AAA for those that have outperformed the index of reference for over 10 years, AA for those that have done it for more than 5, and A for more than 3. And additionally, they have like 50 million euros in AUM. But we know that, for example, there are fund managers that have been an extreme talent and they've shown extraordinary results, but they have less than 5 years of experience in their role as investment directors. But we believe that they're eventually going to be added in the main category, so please keep a look at that one. And as he said, we are going to make an update, and hopefully we will finish by 2025. So if you want to have a look within this database, there are basically some filters that are very useful, so you could just drop down the list and choose whatever you need there. So I think I would just leave it here for you, so please present the next presenter. Thank you very much.
Thank you. So anytime you want to exchange ideas about different equity funds, which is the market we've specialized in, or listed companies, we will always be more than happy to do so. And in summary, as I said at the very beginning, we will only show, you can be sure that we will only show entities that we consider value creators on our website, and we will make our best effort to simplify the information to make it as useful and interesting as possible. Regarding the benchmark, so at our annual conference in Madrid on June 16th, we decided to launch our benchmark for the active management sector. And we did that because we realized that many times when investors were thinking about value or value investing, they were not taking into account the performance of all best performing funds in the market. For instance, in Spain, in 2020, I remember reading on the press that people were saying, value investing is death. Value investing is not working at all. Whilst in the UK or in other markets, you could see that people were saying, wow, this is the best year for value investing. One or the other must be wrong, right? And then in 2002 and 22, it was the other way around. Why was that? Because markets move in blocks. We saw in 2020, when COVID hit, that industrial companies, cyclical companies, they went down substantially. So that hurt a bit more certain investors, whilst others performed very well. And it was the other way around in 2022. So in 2020, tech companies, healthcare companies, or several firms performed very well. And after COVID, it was the other way around. So we decided to include a benchmark with some fund managers who perform extremely well, with different styles within value investing. Value investing is paying less than what the companies are worth. You can see some names there. For some entities paying as little as possible for the current free cash flow that companies generate, like Cobas, Valor. We combined those with some entities buying high-quality companies, undervalued companies, like Fansmith, Quantex, we'll also present later, SIA, we also look up to them, A&G, and then undervalued high-quality companies. Many of you will know Bailey Gifford, Blue Whale, so we decided to combine those, and we created 3 different benchmarks too, of European equities, European small caps, and global small caps, just to follow the evolution of the benchmark, which will be different than a normal MSCI World benchmark. We don't know if it will perform better, worse, it's just a benchmark, and we think that the entities will perform well, and it's good also to combine and not to invest only in a type of funds, or so those can be combined, and we think it will be an interesting exercise, and we look up to all of them in the same way as we speak positively about all entities that we like in the market. So now after this, next slide, final one. Yeah. Our focus will always be on value creators, on people behind asset management companies and listed companies. This is a business of people, so we will always try to understand what people are thinking, investment directors, managers at different listed companies. We will do our best to do so, and also on simplifying the information. I hope you found this presentation useful and interesting. You can take a look at our website. You can download the executive summaries and Excel documents of companies, listed companies we're working with. And you can also see our search engine and information about different asset managers. The first presentation today is going to be delivered by Andres Gujan. He's the investment director at Carnot Capital. We realized that it is one of the best performing entities in the sector. He has been awarded a AAA rating, having outperformed the European benchmark since 2007. It's an asset management company with over 250 million euros in assets under management, focused on sustainability and impact investments. We're very impressed by how they think. It's also important to realize that they recently also hired some very good fund managers. For instance, Birgit She worked at a different firm in the past, having performed extremely well. We saw that since inception. She's outperformed by around 5% per year. The benchmark of European small caps, we're very impressed. And we think that the best years are ahead for Carnot Capital. Andres is going to explain what they do and briefly deliver his presentation. Thank you, Andres, very much for joining us today.
Thank you, Javier, for the nice introduction. Thank you, Alexandra. My name is Andres Guyan from Carnot Capital, co-founder and portfolio manager, and I'm accompanied by Janina Bianchera today. Well, resource and energy efficiency. What is it about? And it's best explained from a little distance. So when we look at our planet, it's clear what it is about. In fact, it's about technology that secures the survival of our species, of humankind. Because in the long term, the way we extract resources of our blue planet is not going to be, we cannot uphold that. It's, okay, here we go. I do it here, huh?
I don't know why he's not doing it.
No, it's okay. So we're at almost 9 billion people, and the problems that we face with the extraction of natural resources are hitting our headlines, so to say. We have air pollution, we have overfishing, we have rising energy prices, and most recently we read about a lack of power supplies to run all these beautiful data centers. In the long term, we will operate in a circular economy. That means that we redirect the resources after the usage of the product back into the production cycle. And you can imagine that a lot needs to be done to get there. And these are actually the investment opportunities that we see. Okay, thank you. Now, I will not show you too many numbers and figures. We brought here some pictures, and we see two lanes how energy and resource efficiency can be improved. One lane is obviously recycling of metals, of minerals, of pulp, of also of water, actually not shown here, plastic, and so on. But it's equally important to reduce the consumption of the natural resources. And important, why important? It's definitely much cheaper to reduce the consumption. And here you see a couple of examples. Well, the story, this is actually quite an old bulb, but it shows you that we are on this way of reducing consumption. Heat pumps is also a proven technology in Scandinavia, in Switzerland, but all over Europe, it's not established yet, we have to say. Irrigation, lots of water is wasted in irrigation in agriculture. What you see is dropping irrigation, much more efficient. That saves at least 70% of water. You can retain water, or what you see in the middle down is fish farming. That's a very resource efficient way to produce animal proteins. These are examples of investment themes. Currently, well, these transitions toward a circular economy is happening. I've listed some examples of active markets where we invested in. The first one is renovation of buildings. The magic word here is smart buildings. We see that companies active in renovation are doing quite well. They're growing, whereas the overall construction industry is stagnating right now. We have some examples of the water industry. Wastewater treatment is a very attractive market now. or also the farmland, because nutrition of all these 9 billion people is challenged, and here companies with innovative technologies have very good markets right now. For instance, biological plant protection. We will see an example of an investment company in a minute. Then we have quite a few programs to improve recycling, not because it's a law, but because it's becoming economically interesting. So investments in recycling plants have a short payback period. Well, there is a lot more to invest in. You see an overview here of the themes that we have in our 2 funds. So the first fund is the energy efficiency strategy. The lower fund, the Carnot Efficient Resources Fund, has more topics, not only energy, but also water, earth, that means recycling of minerals, and agricultural land, and clean air. I will not tap on all these themes right now. I just pick a couple of investments. Novonesis is a prominent one. That's a Danish producer of enzymes and bacteria. These are biological products, and they do not cause any contamination or pollution in the soil. Doing very well. That's a multi-billion company and growing. They're also active in food additives for healthy food, for animal feed, etc. Even for biofuel production, they have enzymes. And Tetra Tech is a company that purifies water. What you see here is a plant to clean groundwater. A lot of groundwater is contaminated with PFAS and other substances. PFAS, PFAS. Probably you haven't heard the term 3 or 4 years ago. Now it's a big topic everywhere. Microplastic, etc. And 2 examples of our efficient energy fund, Belimo. The Swiss people here know Belimo quite well. An extremely successful company, active in renovation, heating, cooling, and then the lower right, Carel, an Italian company, quite similar to Belimo, but less known here. And they are also suppliers for data centers. That's a very prominent topic now, of course, in energy efficiency. Maybe you have noticed that the International Energy Agency has presented their World Energy Outlook yesterday. And this is a slide they showed, and it's the energy consumption of data centers. And they have different scenarios. What I find interesting is how much energy efficiency can do in this trajectory of energy consumption. Maybe you think, well, that's not too much, but let's look at the numbers on the left. We're talking about terawatt hours. Switzerland is not a big country, but anyway, Switzerland consumes 60 terawatt hours, 60 terawatt hours per year. Now, data centers today are around 500, and that is said to grow to almost 1,000. And this difference, this is almost 10 times as much as Switzerland consumes per year. And of course, this energy has to be produced, or it has to be saved, at least a part of it. And interesting is that the Energy Agency says the efficiency, so improving efficiency, costs only half as much as producing additional electricity. And that's basically the investment case for energy efficiency. All right, so how to select stocks? I think it fits very well to what you have said, Javier. It's value creation. And so we do not look at trends or at stories, etc. We look if there is a value creation for the environment, or you can say so. And a technology has to have an impact on consumption reduction. It has to have a benefit for the buyer of the technology, an economical benefit. And of course, for the seller, so the company itself. So we only invest in profit-making companies, and we are particularly careful about return on invested assets. That's our key metric. Yeah, that's about it. Let's have a quick look at the performance of the funds. You see quite long track records. The fund on the left, we started in 2007, as you have mentioned. Well, and we got a prize last year of Provita. In Germany, they found that this fund is the best sustainable fund in the European equity space, not global, it's a European fund, but among European sustainable equity funds, that was the best one. And the Efficient Resources Fund on the right got the prize from, well, I don't know if I can mention it. Well, anyway, it's Citywire. We didn't pay them, so we cannot market it, but that was the best ecological fund globally. Well, this is about it, what I have to say at this point in time. Of course, we would be very interested, yeah, to stay in contact, Javier, and also with you, if you have questions.
Do you have any questions for Andres?
Yes, there's one question for clarification. Performance is in Swiss francs, but you are invested everywhere, so what is your currency? Because, I mean, the Swiss franc this year had versus the dollar or versus the euro, very different.
Yes, this is the performance in Swiss franc, and it's not, well, it's not an easy currency to perform well. Important to know, in the Efficient Resources Fund, we hedge all the foreign currencies. So we are dollar hedged, and that definitely helped this year. It always costs a margin, of course, but yeah, that helped. Mm-hmm. Does that answer your question? Or okay, yeah, sure.
Any other questions? Perfect. Thank you very much.
Thank you.
The next presentation is going to be delivered by Vienny. He works at Edmond de Rothschild. We've been impressed by the strength of the entity in the fixed income market. So they pioneered in different strategies within the fixed income market. For instance, in the one that he's going to explain, they launched a fund in the hybrid debt space, and in 4 years, they've raised more than 800 million euros in this fund. And so that caught our attention, and he's going to explain why and how they do it. Thank you.
Perfect. Thanks for the introduction, Ronnie. So, good afternoon, everyone. My name is Vienny and I'm a bond portfolio manager at Edmond de Rothschild. Of course, as an investor, like most of you, we are about capturing value, creating value. And in bonds, often it's finding the mispriced instruments. And today we are going to talk about such an instrument, which are corporate hybrids. Corporate hybrid bonds, as the name implies, it's sitting between debt and equity. But it's misunderstood by both camps, which lead to the inefficiency. And often that's where the value lies in the gaps between the silos. But before going further and talking a bit deeper about corporate hybrids, I would suggest that we take a step back and think about portfolio allocation. So when you think about the traditional frameworks, the 60-40 portfolio, which worked for a long time, of course, all those assumptions were shattered by the year 2022. There was a first alert in 2018, but it was still benign. But in 2022, we had a positive correlation between bonds and equities, and bonds didn't play the role of a break as they usually did. So the question was, afterwards, should we stick to this formula? Or should we change the allocation? Our view is that still fixed income is back, and that this year we have noticed that the old correlations are back, so which means that every time there is a sell-off on risky assets, actually rates tighten, and the total returns of bonds is positive. And now we think also that given what's changed since 2022 is a starting point. To the end of 2021, the yields were very low. Now we have reached a level where yields are high enough so that they can provide this buffer in volatile times. But the new question nowadays is, should we stick to govies? Should we stick to sovereign bonds? And when you think about the current market, there is really a structural point, which is the deficits. The deficits are large and they are growing. So what we suggest, which type of bonds which will offer enough diversification and a fair compensation of risk? For us, in general, I'm not talking about corporate hybrid specifically, but it's IG bonds from cash-generative companies. And actually, a lot of them are already trading tighter than sovereign bonds. But if you want a bit of pickup, if you want to get even more compensation, we think there is an arbitrage, which is invest in corporate hybrid bonds. So corporate hybrid, if I do it quickly, for what is on paper very complicated. So it's sitting between senior debt and equity. Why companies are issuing such bonds is to defend their balance sheet, because those bonds, they will be treated by equity, at least partially, by both from an accounting standpoint, as well as rating agencies. Of course, to deserve that moniker, to deserve this equity credit, they need to have some equity-like characteristics. So those equity-like characteristics is that those bonds are long-dated, at least 30 years, or even perpetual. It's also, but there is always a call date, which is often very short, 5 years, 5 to 10 years. Or it's subordinated, so it's senior only to equity. And there is the option of coupon deferral. So when I mention those risks, you say, of course I need to be compensated for that. But when you think about, for IG companies, and you are going also in Switzerland, even also, you say, doesn't it look like Cocos, the infamous Cocos, which went bust when Credit Suisse defaulted? Here it's very different. First, we are talking only about non-financial bonds. So there is the government doesn't meddle into that. It's not the government or a regulator which will decide if a bond is going to default. Second point, it's subordinated debt. So of course you will have less recovery if the company defaults, but and it's a big difference. It's the debt can only default if the senior debt defaults, which is a big difference with financials. In financial, subordinated debt can default without the senior debt defaulting. So the default risk is really the same as the senior debt. So the probability of default for an IG company is very low. Second point, extension risk. There is very little extension risk. Why? Because those IG companies, which are often large issuers, they can't afford from a reputational standpoint not to call. So historically, since the growth of the asset class, so 2014, less than 5% of IG issued corporate hybrids have not been called at the first call date. Final point, coupon deferral, it never happens because the savings are not worth the trouble. So on paper, you have of course a riskier instruments, but if you stick to IG rated companies, you have a bond offering a significant pickup versus traditional senior bonds for what are more or less the same risk. So to give you an idea of the pickup, here you have the fund yield, which is slightly above 4%, with a rating around BBB minus. And you compare, you see that you have a pickup of 100 bips. So depending on the time and market regimes, it will be often between 100 and 200 bips versus a traditional senior debt. What kind of issuers do you find in this universe? Because I'm extolling the virtues of IG cash-generative companies, but what are those? So it's, of course, you will find 3 big sectors which represent 70% of the issuance: utilities, telecommunication, and energy. What I find interesting with those sectors, it's of course that they already went over the past few years through their stress test. There was the energy crisis of 2022 for utilities, and you saw that none of those went bust, and they all called their bonds at the first call date. Energy. For energy, the stress test was in 2020 when oil went negative. And once again, you saw that for those type of companies, even for the hybrids, the underperformance was very small. And finally, telecommunication. Now in most countries, it's an oligopoly. So of course, from an equity perspective, it's not necessarily the best business, but what matters for us is, are we going to get paid at the end? And for that, we have quite a lot of visibility. What has been interesting with this market, so it was a niche structure for decades. In the US market, you had similar instruments which were called pref shares. But since 2014, and there was a standardization of rating agencies' methodology, the market has only grown. So now you have a market which is more than 300 billion large, so larger than the European high yield market. And also the big change recently, there's been a change in between tax rules and rating agencies rules. So now the US issuers are coming to that market. And if the US issuers are issuing proportionately to what they are, the market will triple in size. So, which means also issuance, large issuance, means that there is an opportunity because issuers have to pay so that the market can absorb this issuance. So this is the other element which makes investing in hybrids attractive now, even though spreads have tightened significantly. I was talking about defensive beta, why you will find its place as a diversification in the 60-40 portfolio. What you see, so you see compared to the IG, traditional IG senior index, is that you have similar drawdowns, but of course the recovery is much quicker and is much stronger. Similar type of risk, a bit less duration, but of course a much higher carry. And that's through this compounding that you get a much better performance over time. Yeah, it's an extreme example. Usually we don't invest in those type of hybrids. It's an hybrid with a 11-year call date for now. So when it was issued, it was a bit longer. And you see, of course, when the duration, when rates widened in 2022, it suffered, similar to the IG rated bond of the same maturity, but the recovery has been much quicker. And that's why for us, we consider corporate hybrid as defensive also. At EDR, we have been invested in corporate hybrids since the inception of the asset class. Initially, we were doing that for the private bank clients through a certificate. Then we decided to launch a fund 4 years ago. Of course, we were lucky with the timing because it was a time where the spreads and yield blew up. So, of course, the value proposition was very attractive. At the time, double-digit yield for IG-rated companies, IG-rated type of risk. But we still, so of course, we managed to raise quite a bit, 800 million, and it's still ongoing. But we still think it's attractive for the time being for diversification and defensive characteristic. In April, at post-Liberation Day, the drawdown was actually very limited. And of course, if you remember, you have sectors which have very little exposure to the trade. So at Edmond de Rothschild, I think we are a small asset manager, so we don't try to do everything. We're trying to be specialized in niche asset classes, niche segment of the fixed income market, and that's what we have tried to do with corporate hybrid. By creating a team purely focused on this segment of the market.
Any questions for him? No questions now. Good. The next presentation is going to be delivered by Peter, and the RAM Active Investors is an asset management company based in Geneva. Their assets under management are over 2 billion euros, and they're specialized in investing with a quantitative and systematic criteria. They perform extremely well, and their main strategies are emerging markets equities, market neutral, and European debt. He's going to explain why they've achieved those good results and why should people pay attention to what they do. Thank you very much.
Thank you very much, Javier. Thank you very much. Glad to be here this afternoon. So I have joined RAM exactly 2 years ago, being responsible for the distribution of our products in Switzerland and in Liechtenstein. So we've been founded back in 2007 in Geneva. Today we belong to the oldest bank in the world. We belong to Montepaschi di Siena, which has taken over our shareholder a few months ago, which was Mediobanca. But we are run independently, 30 people, all based in Geneva, looking after our clients. Our client base is very much Switzerland and around Switzerland, so very European based. Wanted to give you, I split the presentation in 3 parts. One is a few thoughts about AI. Everyone obviously talking about AI for a few years, but we've been one of the very early adapters of AI. The second part will be why is the case for EM still very attractive, and then a quick word on our fund. So as you can see, we have a very strong technology platform. I don't want to go through all of these points, but I think there are 3 major points that are worth mentioning. One, we have a very industrialized deep learning platform. We have a large pipeline on the LLM side, on the large language models. And last but not least, what's really important is we have our own GPU structure on premises, meaning at Aevis Victoria. If you come and visit us, you can see our servers. It's not somewhere in the cloud. It's really on our premises. And we believe for a small company like ours with 30 people and 2 billion, this is key. The infrastructure is key. This is obviously, everyone on PowerPoint would tell you not to do slides like that, but it clearly shows you how active we are on the AI side for a very, very long time. One of the key things we've done was back in 2018 when we hired Professor Fleuret from the EPFL back then to give us some help on how we should manage our AI platform. And we're now in our 3rd generation of GPU servers. We publish a lot. We need our research also with the academics to be always state of the art. We published actually yesterday a paper on LLMs and stock return predictions. You can download it from our site or ask me, happy to send it to you. The collaboration with the ETH and EPFL is always very important for us. Switzerland, stating the obvious, is a great place to do quant and systematic investing, obviously with the high schools in Zurich and in Lausanne. We all know that the technological progress has been very exponential recently. I think 2020 has been an important year when ChatGPT 3 was launched, and since then there's not a week or a month where somebody new is launching. We had the DeepSeek moment earlier this year. Certainly Chinese technology taking over more and more. If you've seen this week, Kimi K2 has been announced, and it works really, really well. And this is again coming, this is Alibaba and Tencent, they're one of their labs. So you can see that the technology is going very fast. What's very important and interesting as well, if you look at the different green circle, these are all open source platforms. So I don't know if you're aware of that, but 95% of people who use ChatGPT don't pay for it. So monetizing on that will be very hard. We all have witnessed over the last couple of months the massive capex announcements, and I give you 100 billion and I give you a few chips, etc., what we've seen from OpenAI, NVIDIA, etc. We're not saying this really looks like a huge trend, but not everyone is going to win at the end. So be very careful on these capex announcements, and also looking in 3, 6, or 12 months if this capex is spent, and if people are able to find the money to really do that. So this is, you look here at our investment process. Through the whole cycle, we use AI in one shape or form, and that's how we manage the whole equity platform at RAM Active Investments, and always have been doing like that. So from the universe construction to the data extraction, portfolio construction, trading, execution, and also at the end, through active ownership, we use AI through the whole process. And we've been doing that now for many years, obviously having fine-tuned a lot of the processes as technology improves massively. We use more than 500 data inputs for every stock that we cover, and we cover almost 5,000 stocks. The aim of that is that we have a potential alpha for every stock that we cover. But at the end, 3/4 of these inputs are fundamental inputs. If there was only one fundamental input which would be really, really important for us, it's free cash flow. This is at the end. At the end, we were a fundamental bottom-up stock selection firm. And this is really important, and obviously you cannot do this manually, bringing 500 different data inputs into one signal. Covering emerging markets, a lot of people always question us, do you find the right data, the relevant data? Yes, we do. On 95% of the stocks we cover, we find exactly the data we want. And it's still relatively cheap compared to doing US equities, for example, where we would never be able to compete with some of the large quant managers. So the EM space, the most inefficient one and still the cheapest one to get data. So that's the way how we do it. So is EM still the place to be? Obviously, it has been a place where a lot of people were not invested or only a little bit over the last couple of years. A lot of disappointments coming very often. But now, year to date, we're up 30%, and clients and prospects asking, is it still the place to be? We believe from a value perspective, it's still very interesting. If you look at P, you get a PE discount of around 20% versus developed markets. Yes, it has moved up, but we still think it's an important place to be. But also from an EPS growth, one could argue that some of the large Chinese and Taiwanese tech firms have done a lot that this ratio is up like that. But nevertheless, if you look at 12 sectors, 9 or 10 sectors of those have better EPS growth rates than developed markets. So again, we clearly see good growth drivers firing for EM. And there are two other elements how a lot of investors worldwide are positioned. Either they're underweight EM or they only passively invested. And obviously the passive side brings enormous concentration risk, as we will see a little later. So to do that, we've got 10 people, a third of our firm working on the systematic side. We've got 3 PMs. Our CIO is one of the founding members of the firm. 2 other colleagues joined the firm in 2013 and 16, long tenors. We've got 3 quant analysts, where one has a PhD from the EPFL. And very important as well, the IT team, 4 people supporting the team on the data collection, on the et cetera, et cetera. So it's very important also to have an IT that really works well, obviously. And these people do other stuff than just Control-Alt-Delete to make sure that my PC works again. So 1/3 of the company working on the systematic side. So our fund has a track record started back in 2009. Today we manage 980 million. We have a capacity of around 3 billion. I'll show you later why we are limited from a capacity standpoint. And obviously 3 billion is a lot of money for RAM active investments, wouldn't be a lot of money for one of the large asset managers. But again, the boutique approach that we have works really, really well. We target to have an information ratio of 1 versus the MSCI and a lower volatility as well. And did we achieve that? That's at the end the big question. And before we go into performance and other details, what I'd like to stress here on that slide is on the bottom right side, important is that the free cash flow yield is double the free cash flow yield of the index, and you obviously wouldn't find these numbers in developed markets. So we think it's really you see our fundamental value quality approach really going through these numbers here. There are other, like on the PE side, we're cheaper with a higher dividend yield as well. Performance since 2009, on average, we created 5% alpha per year. It has been a little more difficult, as you might see, since August of this year. We underperformed by around 250 basis points through to the very high concentration that we've seen in the market. Names like Hynix, Samsung, Tencent, etc., performing between 30 and 50%. In a diversified portfolio like ours with over 500 names, we suffered a little bit. But we want to give diversification to our investors. And as you can see, when you look at our upside and downside capture, we participate 100% on the upside, which is nice, but we only participate 70% on the downside. So we really try to protect investors' money in more difficult markets, which hasn't certainly been the case this year with the index up 33%, but nevertheless, we believe over the long term, one of the successes of our fund and the outperformance clearly comes from protecting on the downside. Portfolio, no surprise here. With our size, that's what I was meaning with our capacity at 3 billion, we want to give investors access to small and mid caps, mostly mid, a little less on the small cap side, as they are harder to trade. But about 40% of our fund is invested in mid caps. That's where we are able to create a lot of alpha. These are names that are under-owned, under-researched, and the large management firms don't have any place for these names in their portfolios, as the big players clearly want to have more 10, 15 billion portfolios versus the 3 billion portfolio that we would be very happy at RAM Active Investments. Again, on the country and sector allocation, it's important. This is always the result of our bottom-up stock selection. We don't have any top-down elements going into this process. So everything we do, we try to give you a best ideas portfolio with a very strong focus on quality, on value. And last but not least, being in Geneva and not somewhere abroad, we have a very good dialogue with our investors and prospects. And especially for a quant approach, it's important that we can show you how we do it. We have regularly clients in the office. They sit 2 hours with the PM team to see how these screens work, how it works, how a rebalancing works. So we always invite our prospects to come and join us for a few hours in our office. So again, to sum up, active since 2009, very long track record, very stable team, and very dynamically being very close to our investors. Thank you.
Thank you, Peter. Peter, you can stay because, well, I have first one question for you, which is, I was surprised to see how early you started developing artificial intelligence, because many people are speaking now about that, but you started many, many years ago. So first, why and how did you think about the idea that early? How did that happen?
Our management team, and mainly Emanuel Hauptmann, who's one of the co-founders, he was always interested in this. And so that's why the idea came up. And the more data we used to have, the more we were able to have a tool that was slightly better than Excel to help us building portfolios. So that was basically the reason. What I forgot to mention is that our PMs all have dual degrees. They have a financial background, but they also have an engineering background, because one without the other is kind of hard to manage money.
You have any questions? Any further? Thank you.
Thank you.
Now, there's going to be a break of around 10 to 15 minutes, and then Cobas will deliver the next presentation. Hello, everyone. I think you can hear me well now. Yes, better. The next presentation will be delivered by Francisco Burgos of Cobas. Cobas is an asset management company with over 3,000 million euros. They've maintained the same investment policy that allowed Francisco García Paramés to achieve such great results for over 25, 30 years. He achieved returns of around 15% since 1993 to 2014. And they try to pay as little as possible for the free cash flow that companies generate. We believe that the future years will also be very good for them. They will stick to the same philosophy, and we can all learn plenty from what they say and from the explanations. So Francisco, you can start.
Thank you very much for the intro and for inviting us. It is a pleasure to be here in Zurich. and it is a pleasure to collaborate with Tenvalue and with Half Plus, which I think we have a lot of in common in terms of impacting or creating information about consciousness and awareness in investment. I'm here to talk about Cobas, which is a company launched back in 2017, but the story begins, as Javier explained, over 30 years ago, where Francisco García Paramés, founder and CIO, started to manage under the principles of value investing of Benjamin Graham, Warren Buffett. What started with some AUMs in a family office. It was open due to the good performances, and it ended up being an asset manager of 10 billion. As Javier said, the performance after 21 years was of 16% annualized in Iberian equities and over 13% in international equities, which they started to manage them in 1990 until 2014. So Cobas, it is more than just this asset management arm. 15% of the income goes to fund other initiatives. As I said before, for us it is very important to be aligned with our investors. That's why we have Value School, which is a community of people where we're trying to foster financial education with an independent brand from Cobas Asset Manager. We don't want it to be a marketing thing for us. We want to have clients that they know what they're doing, that they can decide whether we are a good choice or not. We have over 30,000 direct investors in Spain in our funds. We also have global social impact investments. It focused on impact investing. They have a debt fund in Africa. They are launching a new PE to invest and improve the life in some countries in Asia. And lately, one of the initiatives we have, it is Palm Harbor, which I'm going to present that in behalf of the founder and asset manager, which is Peter Smith. He couldn't come here. And what we wanted to be is to create a safe space for other managers to be able to develop their talent and manage in the long term. And that's why we seed this project, because the founders saw this potential in the management of companies like the one we have. So these are the core numbers. We are managing 3.2 billion and we're going to work up to 6 billion. That is the maximum capacity. The team in the past, they realized that managing over 6 billion and being specialized in small and mid caps was too much. So in 6 billion, we will close the funds. These are some are the values we have. We are independent. We are the biggest investors in our funds. That means we're fully aligned with our investors. We want to have co-investors, and we don't want to have flows for the sake of having flows. What we want to have is people that are aligned with us, and it creates a win-win relationship. We are specialists on equities. We invest all over the world, but we are specialized, or we like to invest in Europe. We like to visit the companies we're invested in, so that's why we need to be close to them, and that's why we have an investor, a member of the investment team in Asia that has been working with us for 17 years' time. We are long-term oriented because there is no other way to invest on equity, in my opinion, to have good performances. If not, it is very difficult to know what it is going to happen with the equity. This is what we do, and I think it looks pretty similar than most of the value investing in the world. What we want to have, it is high quality companies where we have free cash flow generation visibility in 5 to 10 years time. Okay, so we look for companies that they have a group of control, that have families or important shareholders that let us think that they're going to manage with a long-term view and not to squeeze the performance in the next 2 to 3 years. We want competitive advantage and free cash flow, a strong free cash flow generation. That means that these companies are aligned with our long-term view and it's going to be able to create value in the long term. And of course, we don't like leverage. That's something we think it is worst enemy for the long term. And this is the team. as I said, Francisco Garcia Parames is the founder and the CIO, but the matter of the truth that the 7 of them are co-portfolio managers. They've been working together for a long time. In the former company, all of them, except Vicente, were working together. So that means that they are fully aligned, that they discuss and decide all the new investment ideas together. It is not just a one-man show. So they all have to bring new investment ideas to the portfolio, and they all are involved in all the decisions. It's true that they are, despite their generalists, they're focused on one sectors or in one geographies, but they are involved in all the decisions. And then, anytime we find a new investment, we don't invest more than 0.7 to 1% of the portfolio into that. We want to be sure of what we're doing, and it takes years to concentrate and to get into these top 20 companies that we have in our portfolio, which weighs over 50%. So it is a conviction portfolio, and we are very close of the companies and very close of the management team, and it takes time to have the feeling on these companies. That's why we go little by little. And this all together, this philosophy, this methodology, and this work that has been working for such a long time, let us have this 12% annualized during the last 30 years, which is fine. Here we have some of the numbers we have. And as I told you, we want to have these high quality companies. In the small and mid cap world, it is easier to find. And now, this is the aggregate numbers. So we have ROCEs of 28% that let us have a feeling of if the company has competitive advantage. We have free cash flow yields of almost 90%. It's 5 years. The companies we're invested in are giving back to us what we've paid for them. With a net debt EBITDA of 0.5, very low leverage. And we're paying for that just 6.4 times. And that's very good numbers, and it has been a very good moment in the market to buy new companies. That's been the performance for the last years. As you can see, they are very good, and it's true that in the last years it's been better for the value investor, but it's true that there is a polarized market. It is very directed towards some names. And then we can find these extremely high quality companies trading at 6 times because they are not in fashion, people is not paying attention to them. But at the end, that shows that fundamentals are the key driver in the long term for the right price, right value of the companies. The market, it is very efficient in the long term. Despite this good performance, we still think that we have upside of 114%. It is a very mature portfolio. We've been invested in the top 20 companies for over 6 years on average, in some cases or around 8 years. So we know them perfectly. And the portfolio we find a lot of value, but the portfolio creates value by themselves. But the good quality companies we have, we think that we will be able to deliver good returns in the mid-long term. You never know what is going to happen in the next year, but we are very sure of the value and the quality of the companies we have. This is the portfolio we have. We are very contrarian. That's why in 2017 we started to invest in oil and gas with different thematics. They are diversified within the subsectors we're invested in. Still, after a long time, the long time we've been invested into them, we find a lot of value here, and we are comfortable with this 28%. Sorry. We also like to be invested in defensive companies because it matches very well with our philosophy of long term, with this free cash flow visibility. We also like the cyclical businesses, since in the contrary of the defensive, they match very well with our investment process. We buy little by little. We never know when the cyclical sector is going to hit the bottom, but we know that in the long term, if you have bought at a very good average price, you will get amazing returns. And then we have also some exposure to commodities, and it's pure value approach. We normalize the price of the commodity. For example, in the case of oil, we normalized at $60 because it is the marginal cost of the last producer at the expected demand. It is not something we try to improve the numbers. And we have clear catalysts that let us perform well, even, for example, in 2024, where NASDAQ and S&P 500 perform very well. We as, let's say, value investors, I like to say that we are equity specialists that find high-quality companies, and we are willing to pay, we want to pay less than 12 times. That's what we do. But we have clear catalysts that let us, in the past, to keep up with the pace of the best indexes in the last 5 years at least. And I'm going to share an investment thesis that shows perfectly what we do. And this is not a small cap, this is a large cap that is trading in Hong Kong. And the price of the share price has dropped 50% because of this struggle that they have between the Hong Kong government and the Chinese government. The matter of the truth is the green line up there, it is the book value per share. The family that owns the company has been able to deliver a 10% annualized on the different businesses they have. This kind of, let's say, not a private equity, but a family holding, which they are very good at managing the business they have, their leaders. So if you take a look to the EBITDA, where it comes from, it doesn't come from Hong Kong or from China. Most of it comes from developed countries. 50% of the EBITDA comes from Europe. That means that there is not any point on a drop of the share price because the EBITDA it is not from Hong Kong. And in order you to know how good opportunity that was, they sold the Panama port, and only this port, it was sold for more value than the whole market cap. So if you take a look of the EBITDA, 28% of the EBITDA comes from infrastructure. So that means that at least they're giving us for free the 72% of the EBITDA. So it is a very good example of how it is possible to find value even in a large cap. So in conclusion, I think that investing in high-quality companies trading at low multiples, it is always a good choice. But it's true that in a world with high multiples everywhere in Europe and United States, investing in a companies like that without giving up the performance, it is the best hedge in the future. So it always makes sense, but in the world we live in now, it is even worse, even better. And then we have here Palm Harbor, which it is. They have the same philosophy, and it is surprisingly shocking how different an approach can be within the same process and within the same philosophy. This is a fund of 30 million euros, specialized in small and mid cap in Europe, but they also have around 23% in Asia. So Peter Smith, he's an American guy that came to Europe, and he did the LBS. He had a successful career in big corporates as an analyst and as a manager, but he wanted to do the hard thing, and that's how he get in touch with Francisco García Parama as the founder. So when, after a long time exchanging information, Francisco saw the talent on him. So when Cobas was launched, he joined the team with the promise of launching his own fund with seed capital of Cobas with our support, and that eventually happened in 2018. And since then, you can see that the performance, that it's been amazing. The last 3 years, an annualized performance over 15%. 5 years, it's almost 19%. And since inception, it is at 10%. He's doing very, very well. And as I said, it is very similar approach than the one we have, but if you take a look to the ideas and due to the size of the fund, he's able to find amazing investments. And for example, if you take a look to the case studies, one of the key difference from the one we have, and which makes it a very good complement to the one we are, it is that they are very good, they find a lot of value in special situations. And this is one example. They invested in Telecom Austria, which is a defensive business that low leverage, good free cash flow, and they were going through a restructuring. And even in being in a mature sector, they were able to improve during the last years the top line. So that, as I said before, there is no better driver for to reach its upside potential than the fundamentals. And you can see down over there the good, extreme good performance company had. They also bought Lottomatica, which is a gaming company in Italy, which was sold by a private equity. There's a compounder, so it's a high quality company trading at low multiples. It is possible to find that. So private equity sold it, went public. Nobody wants to buy a company that's been public for a PE. They want to sell it the more expensive they can, and I think it is fair. And they have this single country risk in a, let's say, a sector that could have some trouble with regards of regulation at some point. But if you take up what happened, they have double-digit growth, and they've been able to renew concessions. So you can see, again, an extremely good performance. They also, and as we do, it's time horizon arbitrage, take advantage of what happened in the COVID, where the market was discounting that the world was over. So it is good to invest in aerospace companies like this one, where again it is a successful story. And here you have some fundamental information. So again, as a conclusion, thank you for listening to us. Any question you have, we'll be happy to answer. And conclusion of that, it is possible to find high quality companies trading at low multiples, and it is a guarantee of having amazing performance if you're patient enough. Thank you.
Thank you, Francisco. Yeah. Do you have any questions for Francisco? I'm only going to ask one, which is, we've also seen that you normally, something that we like is that when companies get closer to your target value, you reduce the weighting. Could you please explain a bit that process? And now that the results were good, why shouldn't investors say, okay, I'm selling because it went up? No, I think you are the one selling and buying. So if you can explain that, that would help.
Yeah, as we invest very progressively in the names we invest, we also sell it, and we don't wait until it reaches the upside potential. So when a company goes up 20%, we sell some bips and buy other ones within the company that has dropped. So it is a competition between the names we have within the portfolio to maximize the upside potential, to have the better option. So that let us also avoid liquidity risks in small and mid caps. And I think that's it.
Thank you.
Thank you.
Thank you, Francisco. Alex Rochester, CEO, managing partner at SIA, will deliver the next presentation. They've done an outstanding job. So for the last 20, 30 years, they managed to outperform the main benchmarks. And then we really like the evolution of their investment policy. They decided to create 4 new categories of investments, which we really like because that substantially reduced risks, while they, at the same time as they've been able to prove that they are achieving the results that they expected. They aim to get double-digit returns for the global equity funds and in the natural resources fund. So they're experts in natural resources. They know all commodities, supply dynamics, demand dynamics, and we learn a lot from them. I think anyone who follows them will also learn a lot. So the natural resources fund has performed at the top decile of all funds globally. And Alex will explain how they do it and what can investors expect from global equities and also from their management.
Thanks a lot, Javier. Thanks a lot, Lilian. Nice to be here. Grüezi miteinander. We could talk in Swiss German, but I think it would be unpolite towards our guests. And They have seen or listened to my speech already yesterday, so it could do, but I think it's also recorded, and for them it will be very important. So you know where we are, at the end of the Lake of Zurich. I'm now a tax refugee because my family goes there back since 600 years. So it's just there because we are there. And it's not AI, it's real. I tell when we are traveling. It's really a beautiful place where we are in. Geneva yesterday morning was also beautiful. But yes, we should realize that as much as possible. Now, a lot of things have been said already and will probably become again, but I think it's worth maybe to have at least one speaker to talk about the markets for a second, but not as the market of today, but the markets for the last 125 or 126 years. Now, I found this chart on the internet of somebody that did a recalculation of MSCI World all country since then. And what's fascinating is the moves. Germany being 13%, now less than 2, 24% UK, less than whatever, 4, etc., etc. And what I like a lot is the phase in the 30s. And I'm gonna come back on that. Now, you all know here that all your clients wanted to put the money in the US only. The last 2 years, 23, 24, all the fund flows went to the US. Nobody else was interested in the rest. And you had everybody basically saying, why should I pay an active manager money to pay basically underperform? Now, the right-hand chart on the very right, you have heard it 100 times. Concentration of the S&P 500. But the left-hand part of this chart is interesting. Goldman Sachs went back to the 30s. There was no index, added all the 10 railway stocks, because the 10 largest names were all railway stocks, and compared it with the 75th percentile stock. And they got to a ratio of 700 to 800 times. Where we are now, surprise, surprise, 700 to 800 times. So it doesn't mean that it will collapse, but at least we are not on square one or in the first inning, as they say in US baseball. Now, this is also a pretty old chart used from Goldman Sachs in January this year. David Costin has updated this figure slightly, but the US and Goldman Sachs still expects 3% from an S&P investment for the next 10 years per year. 3% only. All the private investors that want to make 6, 7%, they will have some difficulties. And it's because of valuation, as we're going to hear 100 times here probably today. Microsoft was trading at 40 times in 2000, now it's trading at 37 times. It went down to 11 times when nobody wanted to buy in 2011. Now, we are here value guys, so we have to bang the table for value. We only have 2 funds and all our money in there. The left-hand chart shows only the data for US, because you only have the data for US since the 30s, in which phases value was doing better and in which phases growth was doing better. Now, the light blue shows, okay, dramatic bad performance for value guys in the railway bubble, surprise, surprise. Now we had the largest headwind ever against value guys. Now, this does not mean that it has to change. What could be the trigger? But before that, what's fascinating, if you look at the 10-year rolling returns, now you say, hey, 10 years, that's too far off. But the older you get, the older your kids get, and every of your clients want to pass on for the next generation, so 10 years is something like that. Basically, in 83% of the 10-year rolling returns, value was beating growth. And I think that is just a reminder for all the guys that are just passive out there. Don't put everything in value, for sure not. But at least listen to all guys that are maybe crazy, but maybe they are not so stupid at the end of the day. Now, the other chart, the red and green one, here's a professor from the Toronto Ivy University called George Anastasikos, a real Canadian name. He's coming from Greece, of course. He is actually running the chair of Benjamin Graham Value Investing. And he wrote a fascinating book called Value Investing from Theory to Practice, where he actually asks the question in chapter 1.7, why is actually not everybody a value investor? if you look at the statistics to the left. Now, of course, you all know institutions cannot wait too long to get right, etc., etc., etc. But these are massive chances for people that can deviate from the mass. And he came to the conclusion that you have to monitor US inflation, not as a point, but as a 3-year window. And the moment it's above 2.5, it should be value coming back. Now, he stopped this chart in October 19. Let's see what happened after. That's another interesting chart that I got from a Canadian lady. She is 65 years young, called Kim Shannon. She's managing her own funds since 20 years. In peak, she managed 9 billion Canadian with her own company. She does not need to work. She just does it for fun because she cannot do elsewhere, something else. Now, she showed this chart to me last year in Vienna. In 2006, 30% of all the global managed had a value tilt. Now it's less than 5. We are dying. Old dinosaurs that still believe in something bad. Now, that's our fund. I don't want to go into too much detail. Since 5 years, we were able to beat MSCI World. So basically, since the moment interest rates were going up, inflation was going up, we were able to beat MSCI World by 2% more or less per year, with a beast that has only 13%, 13% in US equities, and none of the big 7. How is that possible? You can build portfolios from neglected stocks because the world has become passive, that hardly any analysts are following these names. And that's basically our view and our chance. Like everybody, we try to find good businesses, good management, good balance sheet at good price, and I think everybody that I know here from the speakers are doing the same. Now, our different way is we like to look at the strategic positioning, but I will get into that in a minute. That is our team. The fund was launched in 2002 with 100 euros. The fund price today is 757, 9% on average, not so bad. Outperformance of the whole period of 200%, but unfortunately not in every calendar year, so in the good value years more and the bad less. And last but not least, we have all our money in our fund. Now, I don't know how many of you know this name. There are some in the audience that know this name. It's the largest producer of sausage skins. Just the skin of a sausage. There are 3 companies in the world doing so. You know them as well. The third one is Chinese. In December 19, we owned the other 2, indirectly controlling 65% of the global sausage skin market. And we like that because it's a niche that is totally neglected. Our valuation, I skip over that, we are substantially cheaper than, and all of you are also cheaper, but we are in the same camp. Now look at this chart. Financial theory tells us that operational earnings should be the best leading indicator of even better free cash flows, but the Bloomberg chart that doesn't produce free cash flow that nicely, so I use operational earnings, should be the best predictor of share prices, future share prices. Now look at this, we were able to buy Heidelberg Cement on the dividend floor. How can that be? Because 3 letters, starting with an E, SG. People got totally taken away. Big money said it's bad to buy or invest in cement producers. Not realizing that you need 1,300 cubic of cement in the foundation of a windmill. Otherwise it doesn't stand still. Now, I have to catch up a bit. There's another company that we like a lot, is ISS. That's for us a sausage skin, because Mr. Ramotti is very proud to say that I'm not making more than 40 times than the cheapest labor in UBS, because it's outsourced now. These guys are all doing for UBS the same. Very sticky. And like MTU, that we also bought heavily, we bought also ISS in the low, because everybody thought, yeah, these things are closed forever. It's not true. They're coming back. And we are flying. When you exit the plane in Zurich, now we have 7 people from ISS waiting until you all get out finally, so that they can clean the plane. So these are mission critical, but not really that much in pricing, which gives the power to ISS. They have actually still, after doubling, a valuation of 11 times. And an IRR in our own calculation of 13.4%. Now, I actually filmed this robot here in Prague in 2019. So basically you can buy an enabler or a profit taker of robotics for a PE of less than 11. I'm not sure if you should buy really the robotics fund that is already 4 billion in size, where you pay multiples that are slightly more expensive, or if you should buy the company that takes advantage of that. We do an IRR calculation for every single company, like in the example of ISS, and then we end up having the same as a sum for the fund. That's the red line. And the blue bars are the NAV of our fund. Now, COVID hit everybody, so the IRR jumped to 20%. And at this stage, we like to say either we were totally drunk because we were drinking too much Spanish wine with our Spanish connection internally, or fund prices have to go up, which they did. Now, currently, the IRR is 16%. Now, from this 16%, you have to deduct our fees, our mistakes that we for sure will do, but then that lets us stream from 10 to 12%, which is much better, in our view, than the 3-4% that you can expect from the S&P 500. Now, maybe this for a second. We also create a bit similar like Paramés does and Cobas does. We have not the line, but we have the bar charts. So we come up with a fair value where the fund should be on a normalized situation. And we got 3 times so right that we had to pay our CIO, Marcos Hernandez, quite a bit some beers. But at 2025, at the moment it looks that we are hitting that, but don't expect us to be there. It could be half. And actually I would love to be half, because then I can buy more for my kids that I do every month. I buy more. Actually, we should hope for the next correction, because then we can buy cheap things, even more interesting. But the anchor, like in the Heidelberg chart, is up there. So we think we have a very nice future ahead of us. Now, we were in 20th of March this year, 5 years behind COVID. So we did the reality check. We were dreaming about 20%, as I mentioned before, and now we came up at 24% per year. So we were lucky with some trades that we did, so we were even able to outperform that space. Now, I think we can just skip that because natural resources is another fund that we like a lot. Totally misallocated. We prefer oil like crazy, because oil is the uranium 7 years ago, in our view. The International Energy Agency, I don't know if you have seen that yesterday, they came up and said, oh, we were wrong. In 2019, we said that was the peak consumption in oil that we just had at 102 million barrels per day. Yesterday, they came out and said, oil demand is probably going to go up, hold on, until 2050. The market is not ready for it, I can tell you. And our natural resources fund was massively outperforming the indices, because we do crazy things. We buy uranium and everybody hates uranium, like my following speaker, Peter Frech, that I know as well, very well. So I think we are all in the same camp. And last but not least, no presentation without AI. I asked AI to make us 25 years older. So hopefully by then we can say we do not only have 120 years of investment experience, but hopefully 220 years. Thanks a lot for your attention.
Alex, hold on. I wanted to emphasize that your good management, also for all of you, is the kind of management that makes us believe in value investing in the same way as other fund managers who came here. No, but I mean that properly, because when we've been following you for many years, and we see that what you said 6 years ago is happening now, and what you're saying now, I'm sure that in 5 years, when people, it's very interesting how in 2008, some people were looking at videos recorded in 2008, 5-10 years later, and that's when they were saying, whoa, they were right. And that's what I think is happening now also in your case, with the low investments in certain sectors and so on. Something that I also like a lot is your experience also in valuation, because at one point in time, we researched some companies that you researched, and our expected internal rate of return was exactly or pretty much the same as the one you're having now, and you didn't explain much about your categories. So for instance, after COVID, your results were extremely well, and that wasn't by coincidence, or because you increased your categories 3 and 4 after a big crisis, and then when the market is very optimistic, you increase the weights of the categories 1 and 2. So if you can explain that a bit more, what do you think now in terms of categories, and what can investors expect? And there may be a few questions too.
Yeah, I mean, in a nutshell, we started the fund in 2002 with the idea we want to buy the cheapest thing in the market that has some quality. Pretty much like Warren Buffett in the early days without Charlie Munger. That was fantastic because we were able to beat MSCI World for 6.5 years in a row by 20%, and we got from 5 million to 2 billion. Now, 2008 hit us heavily because it works fantastically on the upside, but then it works negatively on the other side. Now, in 2011, it took us a time to really wake up and said, okay, we have to change something. So we have to change portfolio construction, not the way we look at companies and analyze it, but the way we put things together. And we came with nothing more simpler than trying to copy Warren Buffett, what he has learned from Charlie Munger. In other words, to have half of the portfolio in companies their earnings are not cyclical, and the other half still the cheap value things. And this combination is fantastic because like that you get to the point where you can really hope for the next correction. Because if you start a year with a 50-50, and then the defensive part holds better, and then you get hammered with oil and copper at -60-70, you can rebalance anti-cyclical. And there are two magic things in investing, and I had to become almost 60 years old for that to realize. One is put average in, average in, average in, what I do for my kids. 200 francs per kid per month goes into the value fund. The 15-year-old has now 70,000 Swiss francs in his UBS portfolio in our value fund. The second thing is you have to build a portfolio, if it's our fund, a competitor fund or whatever, you have to build a portfolio where you can rebalance in a moment of stress. And this is extremely powerful. Thanks a lot, Javier.
Thank you. Do you have any questions? Any of you? Perfect. So thank you very much, Alex, for the good presentation. And Peter Frech is going to deliver the next presentation. He's the investment director at Quantex. He's been awarded our AAA rating, having outperformed the global benchmark since 2007. And we've also been impressed by the way he thinks and the way he invests. So thank you for joining us today.
Yeah, thank you for the nice introduction. I'm presenting you the Quantex Global Value Fund. It's our flagship fund. It was launched in 2008. It's now 1.5 billion and under soft closing, but you can still get in with smaller amounts if you want. So the motto of our fund, our strategy is less emotions, more return. So first I show you some of the returns, and then we can talk a little bit about our emotions. It's very good track record. You can see it here, especially during the drawdowns, 10 years, and maybe here the comparison of our fund with the Bloomberg World or MSCI World Global Index. So over the long term, we beat the index by a big margin, but the last 3 years were terrible for us. This momentum, AI-driven market, that's not good for our strategy. It's in Swiss francs, and it's net performance after all fees. So what the investors really got. So really good long-term returns. So how did we achieve that? I mean, you saw the other charts. The last 10, 15 years were no fun for value investors, mostly. But we still managed to beat the MSCI World over 10 and 17 years. Here's the team. Quantex is a fund boutique. We manage about 2.5 billion, but we have still a small team, 9 people in total. And the three guys on the right are basically managing the fund and doing the research for the fund. I have a degree in psychology. That's a bit unusual, and probably explains a bit why I like to talk about emotions. So no nonsense is our basic approach to investing. We kind of try to get rid of all that stuff that's a big distraction. I think that's the main challenge, all that storytelling going on at markets. it's very hard to stay focused, so it helps to kind of try to get rid of a lot of nonsense, of wasteful things. So we don't do, or we try not to do macro analysis. Obviously, macro is important, but we say we're not smart enough to do macro, to do market timing, so we don't want to do it. We like to talk about it during coffee breaks for entertainment reasons, but we don't do it in our decision making. No market timing, no story stocks, so no flying air taxis in our fund. We don't care about that. And then what's maybe special is we don't do management meetings and site visits. It's also for psychological reasons. I think if you do these site visits, look at the fabrication plants, talk to the managers, etc. When you come back to the office, usually you're not really getting better at forecasting the future of a company, but what's increasing is your overconfidence. I've been there, I've looked at the plant, I've seen it with my own eyes, the manager is a nice guy, blah, blah, blah. So you get a lot of emotional baggage from that field trip. And especially if there's some bad news coming afterwards, I think it's very hard to stay rational if you have personal relations and good memories from a side trip to maybe sell the company. That's very hard. So we try to keep them at a distance. We don't talk to managers. We don't want to have any personal relations with them. We don't want to know the first names of their kids or whatever. We really don't care. We try to stay focused on numbers and facts and figures. And no big bets is also important. We have an equal weight approach. We also rebalance our positions all the time. It's also for emotional reasons. I think if you have big overweight positions, kind of darlings in your fund, especially in the case of bad news as well, it's very hard to admit the mistake and sell. It's too much money, too much ego involved. So it's a very tough decision. And that's one of the reasons why we like to go equal weight. So the investment process, I'm wrapping it up a bit quickly. Then we do quantitative screenings to generate ideas. We mainly screen for free cash flow yields. Then we do a quality check. So we look at the actual annual reports, and in the quality check, the most important part is trying to understand why is this stock so cheap. So we screen for cheap stocks, and we try to find out why it is cheap. And usually, or ideally, it's cheap because there are some temporary problems, cyclical downturn, COVID lockdown, maybe some image problem with the sector due to ESG reasons. The oil sector in 2020 was very cheap, for example, or entire countries like the UK after Brexit, or Brazilian stocks nowadays, they're trading at a big discount, mainly for image reasons. In all these cases, we're happy to buy the stock. If the stock is cheap because there's a real risk of the company going bankrupt because it has too much debt, there's a big litigation ongoing, maybe it loses its government license or whatever. So if there's a real risk that the company might go to zero, we don't want to buy it at any price. So that's the difference to other value investors that say, yeah, if it's cheap enough, I buy everything. We say, no, if there's a real risk that it goes to zero, we won't touch it. Then we do a rough valuation, fair value estimate price based on discounted free cash flows. Very rough estimate. We're not good at forecasting the future, but if we do a rough estimate and can buy the stock at a discount, we usually do it. And portfolio construction, it's a rather concentrated portfolio, around 40 names, equal weight, and rebalanced as well. And then what's special about our fund, maybe compared to others as well, is that we also tend to rotate our value style a little bit, because basically I think there are two main value styles or philosophies. One is going back to Benjamin Graham and others, always buy the cheapest stocks, get your margin of safety from buying cheaply. And if you do that, usually you get a very, very cyclical portfolio that does very well during an upturn coming out of a recession. But going into a crash, going into a recession, usually it also crashes hard, like in 2008. It's kind of a high beta value portfolio that you're getting if you just always screen for the cheapest stuff. Especially in a late cycle market, which I would argue we are in at the moment. If you just screen for, let's say, low P, whatever, high free cash flow yields, you get a lot of very cyclical, highly leveraged companies in your portfolio that will suffer if a downturn will come. And the other approach is Warren Buffett's approach, quality at the fair price. So quality is more important than price. You don't get the best companies dirt cheap, but if you can buy them for a reasonable price, you should do it. And basically what we're doing is, through our screenings, we're looking at a lot of companies, and we also see the relative valuations, the price to fair values, the free cash flow multiples. Quality stocks and cyclical stocks are trading at. Here you see a chart done by empirical research. These are the equity valuation spreads in the US stock market for the last 100 years. Basically, you can read that like a bond credit spread chart. So during times of stress, the value stocks, the 20% of all stocks with the cheapest valuations, trade far, far cheaper than on average. So the spreads spike up like in the bond market. So you can see here the 2020 COVID crash where we were trading at 4.5 standard deviations. So these are set scores. 0 is the long-term average spread between value stocks and the market average. So value stocks are really dirt cheap here. A lot of cyclicals, travel stocks, oil stocks, etc. Here in 2008 as well, and that's 1932. And then when the market normalizes, the fear goes away, the valuation spreads come down, and like in the bond market, when the valuation spreads come down, you get the big outperformance run with value stocks, with cyclical stocks. So that was this huge outperformance from 2020 to 22, 23 that we had. And then when you're at 0, more or less, when the valuation spreads are narrow, when the quality stuff is trading more or less at the same multiples as the cyclicals, like in the bond market, you would say, if the spreads are narrow, we prefer the quality. So the value lies in the quality what you're getting. It's not about going for the lowest multiples, the highest yields. It's then about going for quality. So you can see that bit here on this chart. That's the historical sector allocation of our fund. And in blue at the bottom, you see the kind of more quality, more defensive sectors. And to the top in red and orange, you see the more kind of cyclical sectors. And you can see these rotations that we did over time. And you can also see the market and it's how different sectors are getting in and out of favor. So here in 2012-13, we were owning a lot of technology stocks, actually, hardware stocks, like Cisco or even NVIDIA for a while. They were trading at very low multiples, Seagate Technologies and others, because the smartphone was coming and everyone was saying, yeah, nobody needs a PC desktop anymore. So these were the value stocks at the time. Then there was the Trump rally in 2016-17. A lot of these stocks reached fair value. The valuation spreads narrowed. We bought a lot of defensive names, household goods, healthcare stocks. And then the COVID crash happened here, and we rotated back into cyclicals. This time around, it was mainly mining and oil and gas stocks. And now we've slowly reduced that because the valuation spreads have narrowed. They're getting closer to fair value. And we're getting more into quality stocks here, food and beverage, healthcare again. Also lately, software is getting cheap because inside of the technology sector, people are going crazy about semiconductors, buying NVIDIA et al., and neglecting software, or they're even scared that AI will kill software stocks. So there's some value opportunities there as well. So that's not where we are investing, that's where the others are playing, all this future technology, nice story stuff. We are investing in stuff like that. old and dirty. It's also, sometimes people say, yeah, you have kind of a dark side fund. That was especially true during the ESG hype when we owned a lot of oil stocks. So we tend to go over into stuff that's unpopular. And what's interesting about these names, especially these consumer staples now that are trading at historically low multiples, compared to their own history, but also compared to the market averages, they're probably least prone to AI disruption. So these companies here, obviously they're in the future technologies, but a lot of them will not be successful, will get killed in the next few years and just disappear. But I would argue these names here, despite all the AI, whatever it may boom, whatever it may will bring, in 10 years or 20 years, you still need some plumbing done by Roto-Rooter. You probably still have a beer from time to time, or a smoke even, I don't know. Maybe you still have some cleaning to do, or your robot. But I think that it's a very high likelihood that these companies will still be around in 10 and 20 years and generate free cash flows. And they also don't have to do a lot of CapEx. Because if you're in a new business like AI, you have to do a lot of CapEx to gain market share, to do the data center build out, whatever. So there's no free cash flow, a lot of risk, a lot of it, CapEx is debt funded, and there will be a severe collapse at some point. But these companies, they don't have to do a lot of CapEx, they just generate free cash flows. And here you can see some of the names that we own. So it's probably the most boring portfolio we ever had. In the past, we had the tech stocks, the cyclical stocks, the oil stocks, even some US regional banks for a few years after the financial crisis. And nowadays, we really own the super boring stuff like Nestle, Unilever, Reckitt Benckiser, AB InBev. They're probably the most hated stocks at the moment that you can see. It's also funny to watch their anti-correlation to the NASDAQ. So on days when NVIDIA is down 5%, Nestle is up 3%, and vice versa. So a former low beta star like Nestle has now become a kind of a high beta anti-NVIDIA stock. So there's some interesting correlations going on at the moment. We still own some oil and gas, some healthcare, a lot of these kind of GARP, what I would call GARP quality stocks like Booking, Visa, MasterCard, PayPal, Constellation Software, recent addition. These are steadily growing stocks trading at very fair or reasonable multiples. They're not dirt cheap, but I would argue for the quality you're getting, the price is pretty attractive. And also emerging markets, especially in Brazil and in Mexico, you can find a lot of value these days. And it's not the usual resource and banking stocks, it's really good quality consumer goods companies. Here you can see the sector allocation and country allocation. So we're heavily underweight the US market at the moment. We're not finding much value there. It's all bottom-up driven. It's not a macro call. And that's the peer group comparison. So with that, I'm open to any questions you might have.
I have the first one, because when you also explained to us some years ago also a balanced fund, which we found very interesting, and that's also performing very well. So if you can also explain a bit about the multi-asset fund, and then anyone can also ask you further questions.
Okay. So yes, in late 2020, we launched the Quantex multi-asset fund, which is basically 50% of the portfolio is in equities, according to the same value strategy we're using here. And then what's special is what do we use to diversify the equity risk. On the other side of the 50%, we have 1/4 in short-term fixed income, mainly government bonds, to generate some stability, to reduce overall volatility, and to have some dry powder for rebalancing. And the other quarter, that's the special part, is invested in commodity futures and gold. So it's commodity part for inflation protection, and that worked obviously very well in 2021 and 2022. So our fund was up in 2022 when everybody else was down double digits. And one part of the reason was the commodity part. Another reason was the equities we were owning, the oil stocks. They did also very well in 22. But overall, since inception, that fund also beat all its peers, very nicely.
Do you have it? Yes, there's one question here.
It's something similar to which I love with you also, but at the same time, since you do a different exercise with no emotions, what is your turnover? How do you structure this? How do you change your portfolio?
So it's all bottom-up driven. So it's not that I come to the office one day and say, let's get defensives or whatever. So we still have all these fair value estimates, and we look at the price to fair value of the stocks we own every day, and also the stuff on our watch list. And at some point, we're getting inclined to do a trade. So let's say we own a stock and it's going up and it's now trading at 0.9, 0.95 of our fair value estimate. And now on our watch list is something else trading at 0.6 or so. Then it's an obvious trade to sell the one at 0.95 and buy the one at 0.6. But it depends a bit on the market environment. So during times of stress, like here in the COVID crash, we have very high turnover. Turning over, I think, 80% or so of the portfolio in just 1 year. But here, there was a long quiet period before that, when not much was changing. If you look at the sector weights, it was the same in the individual positions. And here, probably as well, there wasn't much change until recently. So it's all bottom-up driven. Overall, our turnover is around 75% total turnover. So in 1.5 years, we churned the entire portfolio. So it's not a traditional kind of long-term buy and hold forever value approach. It's more driven by this and this rotation, and where we see the most opportunities. So sometimes we are heavily into cyclicals and sometimes into quality and defensives. And this obviously increases the turnover.
Thank you. Thank you, Peter. Another one here.
Question, but I found very interesting, you have Bühne and Nagel. So robotics is also one thing that is heavily changing industry. Mm-hmm. How do you look at that? And so there are some technological elements even in your portfolio, even if it's not large language model or software, but the, let's say, technological advancements within more traditional companies. How do you look at that?
Yeah, well, we don't really have a strong view on that. I think a lot of that AI stuff or robotic stuff will be used by everyone at the end. So it's like textile machines or computers or desktop computers, whatever. At some point, everyone will use it. So where's the competitive advantage? Maybe there's some for the early adopters, maybe not. We really don't know. We're a bit agnostic with regard to that. But what we don't like is companies spending a lot, doing a lot of capex on future technologies with unknown payouts. So you really prefer this area here, where we already have the free cash flows. Companies don't need to spend a lot. There's not much risk involved if something goes wrong, if there's a cyclical downturn, if the technology flops, whatever, we don't get killed. So it's also kind of a survival first approach to investing or winning by not losing. We try to buy the companies that won't get killed in a bad market, in a crash, in a cyclical downturn due to technological disruption. It's not about finding the next NVIDIA, finding the next super stocks. That's not our approach.
Thank you, Peter. Thank you.
Okay, thank you.
you have the microphone. Ah. Urs Beck is going to be the next presenter. He works as fund manager at Arfina Capital. Arfina Capital is a wealth advisory company, an asset management company based in Zurich with around 400 million euros in assets under management. They've been very successful at both segments, so wealth advisory services, and also they manage different funds. We were very impressed by their knowledge in Swiss small caps. So they've been in the market for decades. They know plenty of different managers of different entities. They're specialists in that, and we also learn a lot from them. They've managed to outperform the benchmark since inception, and they are doing a very unique work there, and we also like a lot how they think, and we think ahead of the next speakers. So after, as you know, some Swiss listed companies will present. So it's very good to know a bit more for those of you who are not that familiarized with the Swiss market, some people who will be listening to us because it will be recorded. So it's very good to have this presentation by Urs, and he will speak about Swiss small caps, about why people should pay attention to Switzerland and to Swiss small caps. Thank you, Urs.
Thanks a lot for having me. For the slides, I get this one? No. I just press.
You need to just press here.
Okay, good. So yeah, basically I was invited to tell you a few things about the Swiss market in general, not to market our fund too specifically, but yes, we are a small boutique here in Zurich, and we have a strong focus on Swiss equities. So what I was thinking of when people think of Switzerland, so we have these nice cliches, cheese and cows and watches and chocolate, and the way that makes Switzerland interesting not only for tourists but also for investors is when we switch a little bit these areas. You see that we have in the center of Switzerland, we have a very interesting small bank. Our biggest bet is Surveillance. They just moved from Geneva to Zug. There are a couple of reasons to do such a move. But in Geneva, we have the leading vendor for third-party core banking software. So not a coincidence that you see these names. Many of them are core positions in our fund. If you are a bank, often it's neglected that how tough it is to keep the IT alive. So Tenvalue is the way to go. We got VAT. I just visited this morning also a company which is providing parts for these machines where you produce then finally chips, where all these famous NVIDIA chips, GPUs are produced. We don't invest in NVIDIA here in Switzerland, we don't invest in TSMC, but the machines which stand there produced by, be it Applied Materials, be it by Tokyo Electron, none of them would run without parts from Switzerland, be it valves from VAT. They got a market share of 80%, even in the lowest part of the cycle, margins of 30% plus. So there are these hidden gems which are located here in Switzerland. I obviously put two names which we'll present afterwards. Implenia, I'm aware their headquarter is not at the Lake of Biel, it's in Zurich. But I recently visited the construction site of Implenia over there, and it's quite impressive what they can do. They're the leader in construction here in Switzerland. They have a decent position across Northern Europe as well. And it's very complicated. You know, Switzerland is pretty packed, and when you need a second railway across the lake, it's hugely complicated. And when these projects are out there to bid for, there are just a couple of names who can do that. So when the competition is low, typically helps the price. It also did help the share price. I think this year it's pretty much, it doubled, I guess, pretty much exactly. So that was a good investment so far. And the second company, which we'll present afterwards, I already see the CEO and the CFO back there, or sorry, chairman and CFO of Aevis Victoria. So if you want to visit the Matterhorn, there is a very nice place to spend the night there, and you will hear more about that in a few minutes. Switzerland, what makes the difference? What makes Switzerland so interesting? And if you watch what's happening in Europe, where Germany stands, the issues France has, quite many of these issues we have across the European Union don't really affect Switzerland. So first of all, legally stable. We might more think about the US currently, that it's not always reliable, that what was true yesterday will be the rules tomorrow. In Switzerland, it's been extremely stable. Tax is another thing. But I think on the left side, you see Switzerland has been leading the innovation list or ranking for many years. And why is that? I mean, this is very historically based. We have one natural resource, that's brain power. And we have some very good schools here. Additionally to that, the quality of living, Zurich is always on top of these lists. So if you go more international, if you need strong people, you can get them here. So it's interesting to come here and support companies. So we have a lot of brain power here in Switzerland. A lot of innovation. That's how these hidden gems, like I mentioned, a couple of them are coming up. Many more points that would support the case for being here in Switzerland, have the base here. On the next slide, I wanted to focus on one very specific thing. We have seen a lot of charts today, be it in US dollar, spectacular, in euro, but in the end, what you have in your pocket is the currency you think in. You can change the currency against anything else, but if you plot a chart against Switzerland, that's what's coming up. It's every other currency has been depreciating in the long term. It's typically the differential of inflation. Inflation has been under control. It's typically between 0 and 2%. Our national bank does a great job there. And I mean, in the long run, it's beating everything. When I visited this company this morning, they gave a 2028 guidance in Swiss franc. They do a lot of their turnover in US dollars, and their projection for 2028 is 70 Rappen per US dollar. It's currently 80. So it's we had a long discussion, does it make sense to go away from spot? It has been the direction for many, many decades, and there's no reason to believe that's going to be different. So that's, I think, one of the main reasons why you should be invested in Swiss franc and in Swiss companies. What you see here is the 25 chart of MSCI World, everything in Swiss francs. It's been quite substantial how the SPI did better, and if you want to beat the SPI, which is including the large cap names, you should include or focus on small cap names. That's even a little bit more spectacular. The main difference you have when you look at Swiss small caps versus Swiss large caps, it's a bit more cyclical. It's like 30% of the Swiss small cap index is focused on industrials, while we only have 10% in the large cap space. So it takes maybe a little bit more nerves, but you see in the long run, it pays to go to the smaller names, as we already heard from other people before as well. Let me spend 1 minute on what we are offering at Arfina. We do have a fund as well, which did quite well over time, net of fees. We've had quite a challenging year this year. So far, glad it's not over yet. So I like the expression that fundamentals do count in the long term. In the short term, we've been challenged by the market. And no surprise, the biggest bets you see in the middle, it's the names I had on the chart. I would love to go in details with all these names. They're all fantastic companies with strong management. I do like to see management teams. I think management makes a huge difference when it comes to get best out of a business model. And I would love to talk about that with you after the whole thing here, but unfortunately I have to sneak out. There's Rebelichtli-Umzug this night for my son, so I will leave you after watching what Michel and Antoine will tell us, and after the Swiss two names, enjoy them. Thanks a lot.
Is there any questions for Urs? I'm only going to then ask you one, which was why you chose Arfina because we know all the partners very well. We have a very good impression about all of you. We like the team. We know we are very passionate. But what made you decide to work for Arfina?
Well, it's very entrepreneurial. We were a small team. We were 3 guys, all the same age. Everybody has 25, 30 years experience. We would focus on Swiss equities, so we have a common theme. We can challenge each other. In a boutique, you focus on research, on being close to companies, to understanding their business models. And before that, I spent 10 years with EFG. Before that, 10 years with Zürcher Kantonalbank. And it's becoming more and more complicated in large companies to focus on your core competence. Too much distraction from, legal compliance, all that stuff.
Thank you. Well done, and thank
Thanks
you.
a lot.
Yeah. As you are aware, I mentioned at the very beginning that we're totally focused on value creators. So now 3 different listed companies are going to present. You know that at the very beginning, so Tenvalue was set up over a year ago, and we started working just with Spanish listed companies. And we wanted to prove that we are very good at selecting good companies with good management teams selling at attractive prices. You can see that the performance of all those Spanish companies has been brilliant. It couldn't have been better. And now we're putting our focus on Swiss listed companies. So you will see presentations delivered by Aevis Victoria, by Implenia. So we've been in touch with different management teams of different Swiss companies. And we were thinking, okay, when we spoke to those companies, will it make sense? Is it good if they speak here? Do we know for sure that it will be a good investment for investors, for those who see? Of course, they need to want to work with us too, but it was a very strict criteria. So we didn't choose between 200 companies, we chose among 40 companies. And these 2 examples, Implenia and Aevis Victoria, are 2 companies that we're sure that for the next 5 to 10 years, the performance will be good. Why in the case of Aevis Victoria, we think that the performance will be good, there will be a lot of value creation, both for Aevis Victoria, for investors too, because first, they own extremely valuable assets. So if you see the net asset value, just by knowing how much the assets are worth, it's obvious that the real value of the company is way higher than what the market cap is reflecting. In the past, we hadn't seen that big discount ever. So, and it's not just that the value of the assets, they own a lot of real estate, they own a lot of very valuable properties, and they are the second largest hotel operator in Switzerland. But it's not just how valuable those assets are, but also how they've been able to increase the value of the company over the last 10 years or so, even since inception. So it's multiplied by 3 times the value of the company, and there's now a big discount. So we think now is the right time to put focus on their activities. And today, Antoine, the chairman, will explain what they do and what investors can expect from them. And thank you very much for joining us today. It's a pleasure to come on. Thank you.
I have a mic, I think. Hello, thank you very much for inviting us. So I'm Antoine Hubert, I'm the founder and chairman of Aevis Victoria. Michel Kirsch is our CFO, and our CEO, Fabrice Boden, is not here because he's taking care of the business. In a nutshell, Aevis Victoria is stock listed in the Swiss SIX exchange. Michel Rebier and I, we form a shareholder group. It's better? Yeah. Okay. So it's listed at the stock exchange SIX. And Michel Rebier and I, we form a shareholder group acting in concert with 75% of the capital. We invest in service to people mainly, and mainly in 2 sectors, so hospitality and healthcare. Our main investment is Swiss Medical Network. It's the leader in integrated care in Switzerland. with 21 hospitals, with more than 70 medical centers, and we are increasing our footprint within Switzerland. Viva is a joint venture that we did with Visana. Visana is the third largest private healthcare insurance provider and number 6 for the base insurance in Switzerland. And we did this joint venture back in 2022 to put on the market a new healthcare insurance product which is proposing integrated care. Genolier Innovation Hub is our last venture. It's a platform for industry in healthcare. It's located in Genolier, which is a small town between Lausanne and Geneva, next to the Genolier Hospital. And the Genolier Innovation Hub is meant to for healthcare industry to work along with patients, real patients and real doctors on a day-to-day. It also included a conference center. Last week we had a global longevity event on 3 days with 350 top key opinion leaders in longevity gathering there. Naissance is a brand that we created back in 2009. It's for longevity, anti-aging, prevention. We have a Naissance clinic in Genolier. We have spa Naissance in all our hotels, and we also have a cosmetic 9 Naissance. AD, Swiss and Well are 2 digital initiatives in Switzerland with other healthcare players. In Well, we are together with CSS, which is one of the leading insurance company, Visana, Doc Morris, Galenica, and those 2 companies are developing app for the patient or for the insured. We invest in healthcare, in hospitality also with MRH Switzerland. MRH Switzerland is the operating company for 11 hotels, 10 in Switzerland, 1 in UK. We started this hospitality venture after Michel Rebier joined me. So he started in 2000 with La Réserve in Geneva, then La Réserve in Ramatuelle and in Paris. And since 2011, we are developing together within Aevis also a hospitality branch. We also have a 27% shareholding in BAT Group. BAT Group is housekeeping. It's a digital, it's a brick and mortar and digital company providing housekeeping. So you go on the website and you can reserve a maid, and it's covering the whole Switzerland. In the Swiss-German part of Switzerland, it's called putzfrau.ch. It is maybe more explicit than BAT Group. Together it's 4,500 housekeepers working within BAT Group. Then we have 2 infrastructure, so real estate companies, Swiss Hotel Properties, with a portfolio of roughly 880 million. We own all our hotels except the Bellevue Palace, which belongs to the Swiss Confederation. It's part of the Swiss government building, and the Grand Ambassador, which belongs to a third party. Otherwise, we own all the real estate, including the hotel almost next door, Eden au Lac, where you can enjoy a meal or spend a night if you want. Then it went on freeze. I think you have to. Okay. So, in healthcare, so we started in 2002 with the acquisition of the first hospital. So he was talking about creating value. We started with 1 hospital, 45 million turnover, and then we started this buy and build. Now Swiss Medical Network is doing more than 1 billion turnover. Naissance in 2010. Then in 2017, we started this integrated care strategy. 2018, we started also digitalization. We are we could be seen as late for digitalization, but my conviction is that the latest the better, because when you wait for digitalization, then you have cheaper software, better software off the shelves. And if we look at the hospital landscape, the first hospital to try to digitalize, they spend huge amount of money for developing software that are now obsolete, because you can find off the shelf much better software. Viva, we launched it in 2023, and the General Innovation Hub in 2024. That's focused on the Swiss Medical Network. You can see this S-curve. So on our 21 hospital, we have some mature hospital that we acquired 10 years, 20 years ago, and they are producing an EBITDA between 20 and 30%. So EBITDA before rent, then we pay a rent, 9% rent to Infracore, our real estate company, and then we end up with the remaining EBITDA. The yellow one are in between, so they're producing between 10 and 20%. We just merged Pyramide Amzé with Bethanien, so we still have some double cost, but we are improving. Same for Providence, there will be then in the green zone. And the red one are the latest acquisition, and they're producing between 0 and 10% EBITDA. Overall, we see this is a study from the Zürcher Kantonalbank. They do that every year, comparing the profitability of hospitals in Switzerland, public and private. And you see that Swiss Medical Network best in class with 16.5, which result from the mix of these different hospitals. Then East London with 13.5%. And the first public hospital is Turmet Group from Thurgau. They have slightly over 11% EBITDA. The other hospital are mostly public hospital. They are producing barely 8%, and I think the average is 4.6% in Switzerland. Then a small movie. Let's see how it works. Do I have to click somewhere or? No?
I think it would only work with PowerPoint, otherwise we can go to the next one. Where's the here.
Does not work. So maybe just to explain how works the Viva health plan that we have developed with Visana. So in the center state, the integrated care organization. That means the hospital and medical center and sometimes elderly home. So it's all in the same company, and it's providing service to all the population with all insurance, with the current setting, so fee for service. So, but we have our health plan, which is the Viva health plan, and for our insurance, for our member, we are billing as usual with the current tariff, but at the end of the year, there is a comparison between the cost of our population, our member, and the cost of the exact same population outside our system. So, and what we save, we receive from Visana. That means at the end of the year, we are paid with the saving that we are producing. So we have a very strong incentive to be more effective, to be, we are not driven by the reimbursement scheme, we are driven by efficiency and quality. And the first year we did in the Jurassian Arch, it's a population of roughly 100,000 people. We had a small population the first year in our member, roughly 1,500 members, and we achieved 12% saving compared to the same population, exact same population, so same age, same morbidity in the normal situation. So it shows that we are able to reduce the cost of healthcare thanks to this special full capitation scheme. Next year, in the second year in the Jura, we more than doubled the number of members, so more than 3,000. And this year, we are currently in the subscription period, so it ends end of November. We will know exactly how many members we will have in this region, but we are on the path of doubling again the number of members. We established a second zone in the Italian part of Switzerland in 2025. We started on the 1st January, and we are starting a third zone in the German part of Switzerland on the 1st January 26. Of course, this reduced the cost, and we can see that for now we have more cost than income because we have only altogether maybe 4,000 members in the 3 regions. But once we cross the 10,000 members, we will cover all the costs for this insurance, and then it will be a net profit. And we can see that with 100,000 people within this insurance, we can talk about roughly 45 million saving, so additional income for Swiss Medical Network. This is the plan, the footprint that we have. So we have 7 regions now. We are going to merge the region Geneva and the region Vaud. So we will go down to 6 regions. We have 3 of these regions with integrated care, and we aim to cover the whole Switzerland with this integrated care for 2030. What's missing to cover the whole Switzerland is the primary care. We have hospital, but we need to buy more medical center or to have some pharmacy within the network to be able to have more capillarity within the population, to have more primary care outlets. And that's what we are focusing on. So, yeah, we have been focusing on healthcare, but we could do the same on hospitality. You've said some word on hospitality and our asset in Zermatt. Hospitality in Zermatt, we are the biggest hotelier in Zermatt with 4 hotels, 300 rooms. We have altogether 55,000 square meters in Zermatt. We also have retail space, so we are also able to reshape a little bit the environment. We want to lift the level during summer because the problem in Zermatt is a huge gap between the winter tourism and summer tourism. Summer tourism quite cheap with a lot of group, and winter tourism very high level. So we will try to close this gap between summer and winter by changing a little bit the retail environment to give also the ability to do a little bit of shopping. We don't want to transform Zermatt in Courchevel. That's not, we want to Zermatt to retain this authentic taste, but we bring some new brands like Patagonia, etc. We bring some new authentic brand to Zermatt. So the strategy outlook, so we will further develop our 2 branches, hospitality and healthcare. Healthcare is limited to Switzerland. We think that healthcare is really a national business because you need to have a network within politicians. You need to know the environment very well. For hospitality, we are open for international. The idea is to develop also other cities like we did with London, with L'Oscar. We want to have other cities around the world. Also to give our staff the ability to move because the young people in hospitality, they like to have experience. And if we have no possibility for them, then we lose them for Hilton, Four Seasons, other big brands. So also to retain these high quality people that we have, we want to have some possibility to send them around, and also to create the brand, to make the brand more visible. If you have an hotel in New York, Los Angeles, then it's with 10, 15 hotels with the right destination in the world, then you have a global brand. You don't need to have 100 hotels to have a global brand. Hospital, I told about the strategy till 2030, so we will move forward. We are also looking in Swiss Medical Network, not in Aevis, but for Swiss Medical Network, to have new shareholder, because we think that Swiss Medical Network is a mature company, and so we are looking for shareholder for Swiss Medical Network, mainly strategic shareholder. So it could be pharmacy, it could be other insurance or other provider. We in hospitality, we will pursue the development of our hotels. In Zermatt, the Mont-Servin Palace will become La Réserve Mont-Servin in 3 years. So we are currently planning the work, and we're going to do this transformation in 27 and 28. We have very limited amount of time to make the transformation in Zermatt, because it's highly regulated. You cannot do work during the season, so we have 4 or 5 months a year to make the transformation. That's why we're going to do in 2 years. We also want to rebrand L'Oscar into La Réserve London. We own the adjacent building where we are going to create a spa, third F&B outlet, and probably 10 to 12 new keys, mostly suite. Yes, so that's about all I have to say, and thank you very much.
Thank you very much. I'm going to start with a question, because we saw that in the past, after a big sale, you made a special dividend. So I wanted to know a bit more about the capital allocation policy and what can investors expect from the company.
Yeah, so as you know, in Switzerland, we had a kind of a credit crunch with the disappearance of Credit Suisse. And that's why we decided the last 2 years not to distribute any dividend. We wanted to retain cash and to be more comfortable for the financing. Now we see that this credit crunch is slowly ending, with a new player coming in Switzerland. We have Bank of America coming, Citibank, other international bank coming and trying to take the place of Credit Suisse. Usually we distribute an ordinary dividend with the operating result of our company, and we are distributing extraordinary dividend when we sell down something. We sold Medgate back in 2022. Medgate was a telemedicine company that we sold. We did a very good return on it, and so we distribute. And so we will restart the dividend policy this year, so in 26 for 25. And there will probably be also extraordinary dividend, because we are currently selling apartment in Zermatt that we bought into a package, and now we are selling this apartment, which are producing additional income for the company. So that's pretty much but we want to distribute dividend, and I think the fact that the two main shareholders own 70% of the company is also a sign that we will take care of the shareholder value and the shareholder interest, because we are mainly concerned about that.
Any from you? Otherwise, I will ask the final question to... yes, there's one here. So
you mentioned the expansion in London, and you're anything towards the east on the roadmap?
I prefer go west, because you're gaining 1 hour every every time zone you cross. No, it's a joke, of course, but we have maybe more affinity and contact now with New York, with London. We have more experience, but of course we are also interested in East. That is no problem. But culturally we are more inclined to go west because we are part of we are European. But of course with a partner, probably not alone. We will not go east alone, but with a local partner, we are very interested in pursuing some opportunity.
My final question will be, did you envision this when you started in 2009 with the company with just one hotel, how difficult that was, and what's driving you now that you've achieved this to continue creating value? And I saw you are very involved with this new big project, so if you can tell us a bit more, what's driving you and how difficult it was at the beginning?
So no, when we bought the first hospital back in 2002, we had no idea that we will be creating the first integrated care group in Switzerland. Of course, hospitality has been started by Michel Rébier back in 2000 also. He was not part of the group, but he started that with a clear idea to establish 10, 15 La Réserve around the world to create a brand. He wanted to create a worldwide brand without having 50,000 employees, and hospitality is a way to do that. And we are focusing internationally on La Réserve, not other brand. La Réserve is part of what we call ultra luxury. I prefer to speak about boutique luxury. So hotels that are less than 100 room and where we focus on the customer need. And maybe since you put the slide, that's the discount we were talking about. So if we do the sum of the part, of course, miscellaneous are all the small investment that I talk about. Then Infracore is our 30% that we own in Infracore. Swiss Hotel Properties is our 100%, is the net asset value of the 100%. So of the hotel buildings. Emirates Switzerland is the operating company. And Swiss Medical Network, the 1.5 billion, is based on the last transaction that we did in December 24. That's how we come out with this more than 2 billion value of the company.
Thank you, Antoine. As it always happens with these kind of cases, it's just a matter of time until the market cap and the price reflects the real value of the company. We don't know if it will happen in 3 months, in 6 months, in 2 years, but it will happen as it always does. At the end, for the mid to long term, prices do reflect reality and the cash ability generation of companies. And of course, with a good management team, good business model, and an attractive price, so we think it's the right time to take a look at this company. Thank you very much.
Thank you. Thank you.
So you mentioned strategic investors. What would be the ideal strategic investors and from where also? Yeah.
So for Swiss Medical Network, which is a healthcare venture, we do not exclude foreigner, but healthcare it's a national matter in all countries. So ideally, investor would be Swiss player with already a footprint into healthcare. We can name all the usual suspects, but you have, for instance, Migros with Medbase, which would be complementary with the Swiss Medical Network because they are focusing on primary care and we are in secondary care, so putting that together. Could be pharmacy also, pharmacy chain, because the pharmacy, they need to find a new purpose because slowly the business model of a pharmacy is going to an end with e-commerce, etc. And the pharmacists are almost doctors. And so it's like if you put a physicist behind the cashier at La Migros. Having a pharmacist in a pharmacy now is just behind the counter and typing prices. It's an overkill. A pharmacist could solve probably 80% of the basic need of the population regarding healthcare. And so integrating pharmacy into a real healthcare provider could be a win-win, and Medbase did that. Within Medbase, they merged pharmacy and medical center, and it works. It worked good. Could be insurance company also, because we are very happy with our partner Visana, but maybe another, maybe non-healthcare insurer, or an insurer, because the healthcare insurer in Switzerland have really different weight depending the region. Visana is very strong in Bern and in the Mittelland. There are other players that are stronger in Zurich, stronger in the French part of Switzerland, so it could be, or could be long-term fund, but very long-term, because we see that we are working on these projects in 22 years. And so we don't want to have private equity guy who wants to flip an asset within 5 or 7 years. We want really long-term commitment because we are here to stay. And I think being shareholder, it's like when you marry your wife, it's for life, if everything's fine.
Thank you very much, Antoine. Very well presented.
Thank you.
I hope you found that very interesting too.
Thank you.
Luca Rossi, the head of investor relations at Implenia, will be the next speaker. We were also very surprised in a very positive way by the business model, because what we truly liked was that the company decided to evolve for the last years. So they decided to focus on areas with higher margins, more maintenance business, more services, paying a lot more attention to risk. And then when you take a look properly at the numbers, you see that the depreciation numbers are quite high. So initially, if you see that the capex required to maintain the business is way lower than the depreciation figures, even so the net income numbers are not that important compared to the real free cash flow that the company is going to generate. So we calculated segment by segment the value of the business. When we properly looked at it, it was around 9 months ago approximately, so we saw around 2,000 million euros in value. The share price has performed very well, and we still think there's more value than what the market cap is reflecting. Also, we think that the market overall, they're thinking that the revenues for the midterm will be kind of flattish, but they truly benefit from increasing public spending in Germany. So we think that for the midterm, revenues are going to increase more than what the market are expecting, and they're going to generate a lot of free cash flow, which we think that many in the market haven't crunched properly the numbers, and they don't expect those high free cash flow figures that we expect for the next 5 to 10 years. Luca is going to explain the business case. And thank you again for joining us.
Thank you very much, Javier and Alexandra, for inviting us. As Javier mentioned, we are a Swiss-based real estate and construction service provider, but we have presence across Europe. I'm gonna just give you quickly an overview about Implenia, then head into the equity story, and then a brief overview of the first half-year results. So Implenia is having an order book of about 7.8 billion Swiss franc. That's a little bit more than 2 times the annual revenue, and as a consequence, our visibility is relatively good. We have currently a guidance out for this year of about 140 million Swiss franc, and we have also some midterm guidances out there, as you can see on the slide. We are structured into 3 divisions. Buildings, that's real estate development, so we purchase land, we develop it, and we sell it, typically with a construction contract to to a financial or real estate investor. So we don't own the actual building at the end of it, of the period. And then, of course, also buildings division also does regular buildings construction. Buildings construction, there we are fairly diversified, and we have presence in Switzerland and Germany for this division. In the division civil engineering, we are specialized in tunneling and other related complex infrastructures like bridges, roads, railroads. And we are present in this division not just in Switzerland and Germany, but also in the Nordics, Sweden, Norway, but also in France, Austria and Italy. And the service solutions division is our higher margin division, which does complementary services, not construction, but services for the construction sector. Our biggest business in there is the Wincasa, which we acquired about 2.5 years ago, which is the largest property manager in Switzerland. I will highlight a couple of key investment highlights over the next couple of slides. First of all, I think we are focused on relevant and growing markets. The overall construction market has been contracting over the last couple of years. And so it has been a little bit of a challenging situation, but now it's the first time in many years where actually the overall market in all of our markets is expected to grow over the next couple of years. And not just that, but we are focusing, or we're trying to focus on certain specializations. And these specializations tend to grow much faster than the overall market. So the overall market is going to grow anywhere between 1% and 3%, depending on the year, depending on the country. But the specialized markets like the data center, tunneling, or healthcare market, this is for construction, just to be clear, is growing substantially quicker than this general market. Furthermore, we are a leader in certain specialized, rather higher margin sectors. And these sectors are healthcare in Switzerland. Healthcare, i.e. building hospitals, clinics. We are currently working, for example, on the largest hospital construction site in Switzerland. It's called Cantonal Hospital of Aarau. It's a 600 million Swiss franc site, and also a couple of other hospitals. Then research and education, that's mainly laboratories, schools and universities. Here, as an example, we are working on the biomedizinisches Department from the University of Basel. It's about a $250 million laboratory in the city of Basel. And data centers is, of course, very exciting for us as well. We are by far the leader in this segment. We are currently building 3 data centers around the Zurich area, and there will be significant more to come in the coming years. Then civil engineering, of course, tunneling. We are not just the leader in Switzerland and Germany, but we would say across all of our markets combined. And this is mainly because of our history of tunneling expertise that dates back more than 100 years ago. And then service solution, as I mentioned, Wincasa is the leader in Switzerland. Having said that, while we are focused on certain specializations, we still are very diversified, and this is on multiple levels. And this diversification gives us resilience and stability. So which one are those dimensions? Number one, just from a geographic perspective, about 50% of our revenue is generated outside of Switzerland. So we have the stability of Switzerland, but also some of the growth areas like Germany, which Javier mentioned earlier on, which is just announced a huge 500 billion euro infrastructure package. Germany is our second largest market with about 25% of our revenues being generated there. Then from an offering perspective, we are doing all kinds of construction projects, tunneling being the largest, but we of course also are present in a lot of other segments. While we mainly work on large and complex projects, because we have thousands of projects, each individual project is not very relevant to our revenue base. So meaning to say, the largest project we currently have, which is the Brenner Tunnel in Austria, only generates about 4% of our revenues, annual revenues. So we are highly diversified on that level as well. Then with regards to clients, of course, we have a good mix between private and public clients. The private clients, just to be clear, these are, of course, not individuals. These are large corporates like banks, insurance companies, property developers, and other industrial companies. And the contract models are changing, actually. There is a lot more types of contract models where we are earlier involved and not just doing the construction by itself. Now, one very key part is we believe our portfolio and also the pipeline is of high quality, and the reason for that is our value assurance approach. The value assurance approach is basically our risk management process, which was introduced in 2019-20. Of course, we had before a different risk management process, but this here is fairly different. It runs across all our projects. We are classing each project into one of 4 categories, and it always involves a business person, a legal person, a finance person. So that means no single individual person can get a project by himself just based on his own interests. It needs to make sense. Legally speaking, contract is of course always an extremely important part of in construction, but also financially and from a strategic perspective as well. Our management team has been working together for quite a number of years. We see here on the left-hand side, Jens Vollmar, he's a new CEO of Implenia, but he has been with Implenia for 13 years already. He has been now the new CEO since April this year. And these ladies and gentlemen here on the slides, they are from diverse industries. So it's not just all construction people in our company, but it's very important that different industrial veterans are bringing in new ideas into the company. And all of the above, all of the prior set points, I think will lead to sustainable growth that will, of course, in the end benefit investors as well. We believe we can differentiate us with different specializations which bring more value to our customer, but also more margins to ourselves. Then, of course, also we want to grow geographically, but only in areas where we are specialized in, because that's how we can add value. Typically also similar to earlier what was mentioned with a local partner, which is very important for us. And then we want to expand along the value chain, both organically and inorganically. Very quick wrap up of the first half of the year. We only report twice a year, so hence we don't have a 3Q numbers. But I think that the key operational highlight was really the market recovery, the market outlook. As a result of that, we have been able to win a lot of new contracts, both in the civil engineering space, particularly in Germany, which is, by the way, all not funded by the new infrastructure plan yet, as well as in buildings projects. From a financial perspective, that has led to a record high order book of 7.8 billion, which is about a 10% year-on-year increase and a 15% increase versus the end of last year. and also our EBIT has increased about 13%. First half of the year is always worse than the second half of the year. There is a huge amount of seasonality in our business. Our EBIT has increased across all divisions, so we have 3 divisions, but I have split out the buildings division. I've shown it as a division by itself. On the left-hand side, it has increased substantially. This is mainly because of the real estate development business unit, which did very well in the first half of the year. But also the non-real estate buildings business was growing both in terms of absolute numbers as well as margins. And the higher margin service solutions business with 7 to 8% EBIT margin has also been improving. These here are numbers, semi-annual numbers, so you can see there is this seasonality. Always first half is generally worse than the second half, in particular when you look at cash flows. But what is very visible is that from an EBIT perspective, we have been able to, being constantly generating strong EBITs. We have always, in the last 4 years, been able to meet our targets that we have announced to the market. And the free cash flow, which is typically negative in the first half of the year, has generally been caught up in the second half of the year. Equity ratio has doubled over the last 4 years. We came out of a transformation phase prior to that, and we have a midterm guidance, equity ratio midterm guidance of 25% out there. And last but not least, I think the trading environment has improved substantially this year. We have been able to increase our free float to over 86%. The average trading value is now more than 3 million Swiss francs per day, and we have been able to attract a lot of new institutional investors, both local as well as international. And very recently, we've been able to refinance our maturing bond from next year. We have early refinanced it. And so, as a consequence, the next maturing bond is in 2028, so we have a fairly good visibility there as well. So, to wrap up, Implenia is growing with a differentiated offering, and happy to answer any questions you might have.
Thank you, Luca. Do you have any questions? I'll ask you one question, which is regarding free cash flows, because when we first spoke, you explained that very well too, how free cash flow is expected to go up substantially. So if you can please explain that, especially for those who are just starting to research the company, what makes you confident that the numbers will be positive and good going forward?
Yeah, we have been hit on the free cash flow perspective in the last couple of years due to several reasons. Number one, increasing interest rates has an effect on prepayments, and a big substantial part of our free cash flow also comes from prepayments for our projects. So we try to be as much pre-financed for all of our projects as possible. But of course, when the interest rates went up, the prepayments were lower. That's number one. Secondly, the buildings market, as I mentioned, we came through a contraction of the overall market. So the buildings market has been decreasing up until end of last year for like 3-4 years in a row. And as a consequence, because buildings generate more prepayments, these prepayments has also been decreasing. Now, this has changed end of last year. So since mid to end of last year, we are growing again in buildings, and the interest rates have been decreasing again. And as a consequence, from a prepayments perspective, we are expecting substantially better results. Then secondly, also from a change order or claims perspective, we are implementing new measurements which will improve our contract assets, so our claim situation vis-a-vis our clients. And so in combination of those two factors, we believe that the free cash flow situation will be substantially better going forward.
Thank you very much, Luca. The later results were very good, in line with expectations, and we believe that the next years will also be really positive. So thank you very much for presenting today.
Thank you.
As you could see before, those two presentations were made by two really good companies, and we believe that the future performance will also be very good. Sometimes we also like to work with smaller companies. It was the case last year with Libertas 7, when the market cap was just very small, under around 25, 30 million, and the market cap now is 3 times that. And that happened because the estimated value of the assets was 5 times more. They decided to communicate a bit more, and their policy was also very good for minority shareholders. They increased dividends, the market reacted, and the trade volume increased substantially. Something quite similar we think is happening with Catenon. You will see that it is also a very small company. Compared to 1 million, or compared to those companies of 1,000 million, so the market cap is around 20 million. At the same time, we believe there's a huge inefficiency in the market with Catenon. So it's focused on the human resources market, and they are able to hire around 1,000 people per year, and they expect to hire between 3,000 and 4,000 for the next 5 years. So EBIT and net profit will increase along those lines, as always, because now the company is expected to generate an operating profit of around 2 point something million. As the company grows, operating profit will grow along with the number of people they hire, and we think that the market cap will increase at least in line with those numbers. So sometimes, we know not all investors are interested in such small companies, micro-cap. Some of them do, and we were happy to see that some of those were interested in Libertas, and we think Catenon is also an outstanding case at the moment, and that's why we decided to invite Jan. So we think you'll find that very interesting. Thank you, Jan.
Thank you, Javier. So my name is Jan Ramboursek. I'm the CFO of the Catenon Group, and I've been left with the difficult task of speaking last. So thank you for your patience and for being there, right there. A few words about Catenon. So I suppose that this is, yes. So this is the topics that we are going to cover. First, a few words about the market. The market we are in is talent acquisition. Talent acquisition is a very, very, very hot topic around the world. When you ask to world leaders what is their main concern on their agenda, more than 80% of them in most countries would cite talent acquisition as first topic. When we talk about the market and the potential growth of this market, we are talking worldwide about a 21 billion market currently that is forecasted to grow up to 74 billion in the next 5 years. The growth driver behind that is not the growth of our clients, who are organizations that need to grow and expand. The growth driver, the main growth driver is the turnover, the churn of the people and of the professionals within the organizations. And post-COVID, you all know and are well aware about the wave of rotation that has struck organization worldwide, and this wave is not over yet. Few words about Catenon. Catenon is a company headquartered in Spain. It was born in year 2000. So 25 years ago. We are now present in 25 countries. Here we have 23, but we are 25 countries now. We have done operations, meaning searches for candidates on behalf of our clients in more than 100 countries. and we are listed on the stock exchange in Madrid since 2011. We are a technology-based company with a proprietary software that we've developed early on to solve the equation of looking for candidates anywhere in the world, based from anywhere else in the world, and to present the results in real time to our clients on our platform anywhere in the world. So we operate differently than most executive search firms who have offices all over the world, and they refer clients and candidates to their local offices. We operate as one planet, one office, and we share our resources across the globe. So when we talk about the Catenon Group, we have first the Catenon brand, which is the executive search company that was born in 2000. A revenue growth of 20%, more or less, and EBITDA growth last year 100%. This is a business model that is based on a demand model, where the number of candidates for one job is superior of the number of jobs offering. Based on technology, and the target is international professionals, mid to top level. We have a younger brother in the family, Talent Hackers, born into 2021. And this is a company that is focusing on the technological talent, so IT professionals in general, for the moment only in Spain, where we are testing really this business model. And this is based on a supply model where you have many more job offerings than you find candidates on the market. Again, the technology is proprietary. We have developed the platform, and we integrated data analytics and nodal technology. And you'll see a little bit later what results does it bring. And we have launched this year ByTask, which is a marketplace. So we have no results for the moment. And this is a marketplace where the number of candidates equals more or less the number of job offering. This is also targeting the technological talent, but on a task level. So not for permanent jobs, but for small tasks on a freelance basis. And we're using our own technology also based on data, intelligence, artificial intelligence, and Web3. And this is the Catenon Group. As for results, I'm CFO, so I can't help but talk about some numbers. This is since 2020, the evolution in green, the revenues, and in blue, the EBITDA. So constant quarterly growth over the last 5 years. These were the 2024 results, so 14 million in sales, with an EBITDA of 1.5 million. Solid balance sheet, almost free of debt. And this is the 9 months of 2025, which we just published a couple of weeks ago. So the first month of 2025 show a growth in revenue of 21%, and a growth in EBITDA where we almost doubled or more than doubled the profitability of the group. Talking about Catenon, so the first one, born 25 years ago, we are the first global platform of digital recruiters. So we have a virtual model of operations where we operate worldwide as one office using the same methodology, the same tools, and our consultants can be based anywhere in the world. This is standardized methodology to guarantee the same level of delivery everywhere in the world for our clients, because most of our clients, we work for them in multiple geographies. I'm going to skip that, but this is because I have a small movies. I saw that we might have some technical issues there. So we have a client, let's say LG Electronics, with a EMEA headquarters in the Netherlands. A French-based business developer who is in contact with this client, LG Electronics. They are looking for a B2B director in Jeddah in Saudi Arabia, and the consultants will transfer the operations to our one of our platforms of operations, either in India or in Madrid or in Mexico. Here, India would make more sense. Our main asset here is the client relationships that we've been able to build over the years with a very strong addiction to our tools. Most of executive search companies are kind of black box. You gave them a mandate, they disappear for 3, 4, 5 weeks, and they come back with a list of 3, 4 candidates with a CV and a report. And you don't really know what's happening in between. With our tool, we have a complete transparency over the process with our clients, so they can follow any search they have in the world in real time to see how many candidates do we have in the pipe and what information have we been able to gather on those candidates along the process. Talking about now the talent hackers member of the family. Talent hackers, as you remember, tackles the technological talent. So what is it exactly? We regroup the job offerings that our main clients may have, like Banco Santander or Orange, in our platform, and we distribute it. So this is one job offering, and we distribute it in social networks, attacking the nodes of those networks, so that we get the job offering to the passive talent, which is almost 90% of the IT or technological talents. This gives us, because all this is tracked through blockchain, all this gives us a map of the technological talents. So for the moment, we have mapped more than 650,000 IT professionals in Spain alone. And we know their perfect technological stack. So if they develop in Python, in Java, in iOS, whatever, what is the companies they are working for, where did they study, where do they live. So we have a huge amount of data on this talent pool. And this is our main asset, because we are able to provide added value on on the knowledge the market has provided us to our clients as employer, and help them build their talent acquisition strategy accordingly to the data we provide. ByTask is the younger brother and the newcomer in the family, a couple of months old. And the origin of ByTask is basically when you look at an analogy, you would look at Airbnb. So Airbnb has woken up the owner of private homes that are inoccupied, and has created on-demand housing. Well, ByTask is waking up the freelancer or the technological talents that have free time and are really able to help on a task basis companies with their IT issues. And operating with talent hackers and Catenon in our day-to-day, we have detected that more than 85% of IT professionals would be willing to help small businesses in their free time without leaving their normal job in order to earn extra money. So as a marketplace, we have a demand curve. So the demand curve is created by the SMEs, and the SMEs usually have at most one IT guy, but they are using between 10 and 20 different technologies, and they need help with that, be it for their accounting, for their sales prospection, cyber security, emails, you name it. And there is also a Pareto problem with this demand curve, is that 80% of the problems are generated by tasks that are between 30 and 150 hours. So it's not huge projects, but it's small tasks that are generating the most issues. Supply, on the other hand, we have a trend toward pluri-activity. So we have more than 600,000 people in Spain alone that have multiple jobs or multiple activities. And this is a global trend. And we have also seen by qualification, so the higher the qualifications, the higher the willingness to have multiple activities. And by age. So we have also a higher willingness to have multiple activities or multiple jobs in Gen Z and millennials. So this is basically the marketplace. On one hand, in Spain, we have 1.3 million SMEs with more than 5 employees. We have, on the other hand, the tech talent database that we have with 650,000 professionals, IT professionals in Spain. And we have developed, or we are now launching this marketplace to bring those two together and match and earn the fees in between. And that's it. Thank you very much.
Thank you very much. Do you have any questions for Jan? I'm going to ask you only one question. So, seeing all the operating profit that you're able to generate, that's without ByTask, and I think it's very important to realize and remember the payoff or your investments in R&D, because the platform for growth hackers, for talent hackers, sorry, you spent around €1 million there, and now that's already more than 30% of the operating profit. Exactly. So can you please explain why you think that the market hasn't reacted yet? If investors may be looking at this, are we missing something? So what do you think about that? And then also you explained how investments for Bytask will be separate from the other entities, and the amount of money that you will invest is limited. So just by looking at talent hackers, we think that the value just with that is way higher, but then you also have the potential of developing. It looks very good, it looks perfect, but just with the other part, there's a lot more value than what the market cap is reflecting. So if you can also explain on that.
Sure. There is more than one question. So I try to remember all the points that you mentioned. So first of all, regarding talent hackers, so we have invested about €1 million in talent hackers over the last 5 years. We've grown from 0 to 3 million euros turnover, probably more for this year. And we are already generating something like 25% gross margin, operating margin on this business line. We publish results, so why hasn't the market noticed? We are a small company. We are in the secondary market in Madrid, in BME growth. We publish results every quarter, but we do not really make the distinctions between the business lines as yet. So we'll see what will be our strategy for communication on that in the future. As for Bytask, we have again same strategy as Talent Hacker. We have a maximum amount to invest because we generate most of the cash flow and the resources for investment on the business of Catenon that is 25 years old. So Bytask, same strategy as Talent Hackers. We have a limited amount to invest, and we will separate completely the management from the rest of the businesses, although there are some complementarities, obviously, because of the data that we manage as a group. These are fundamentally different business models, different client targets. With Catenon, we are targeting large companies. With Bytask, we are targeting really SMEs, and the link between is the technological talent.
Thank you. Thank you very much.
You're welcome.
Another question?
Can you give us more color about the strategic plan and what can we expect for the next 5 years?
Okay, so next 5 years, I have no crystal ball. We have a sector where the visibility of the business is quite short term due to the fact that the clients have a need because someone has left the organization or has been promoted, and they have not really planned that really far ahead. But I'll try to explain. So for Catenon, the strategy is to continue to grow and expand internationally. We have, as a short-term or mid-term aim, to be leading the market in Spain. We are already in the top 10 executive search firms in Spain, but the aim is to be number one. For Talent Hackers, we are only catering the Spanish market for the moment. So next step will be most probably an international expansion. We have two directions where to expand to. One is the close Latin American markets, so Mexico and Colombia, where you have a lot of IT professionals that are working already near shore for the US. And this is continuing to expand, so we'll have to acquire data on those markets to be mapping the technological talent in these markets. And the second direction where we could expand to is the Indian market, where we have a long experience. We've been in India since 2010. And as you know, India is known worldwide for technological talents. So these will be probably the two directions for talent hackers. As for ByTask, we need to test it first. So we'll see how it goes.
Perfect. Thank you all for joining. I hope you found the presentations very useful and interesting. And now it's time for the Tenvalue and drinks. Thank you very much.